Hi, everybody. How you doing? Everybody there? We got four on the line. This is Lauren. How are you doing?
Good.
Good. All right. Let's see. I've unmuted everybody so we can start some conversation here first. Give me an idea as to what your weak spots are that you want to emphasize a little bit more in tonight's webinar. It's quiet out there.
hmm
All right. So, who has a scheduled test date?
Somebody.
Nobody. Wow. Okay. You want to put a deadline to this exam. Um, the more that you wait, think you're not ready, the more you're going to push it back, and the more you actually forget than retain. Always keep in mind this is all short-term memory. Just hunker down, focus, study, pass the test, and you're done. Continuing education is typically online with an open book exam, so that's the easy part. So, all right. Between the property and casualty exam, this one's typically easier for most people because it's more of a conceptual exam. Okay. All right. All right. I'm going to leave it unmuted. If it gets too noisy, I'll go ahead and mute everybody, but we'll go ahead and get started. Okay. If you have not registered and considering, go to lgdstudy.com. This particular program, the Life Agent or Life Accident and Health program, is only $50. If you do have questions even after this webinar, you can call me, or you can also email me at lauren@lgdconsulting.com. Okay. All right. So they do have some talking over here. So, okay. We've got a question here. Boom. Can't speak. Okay. Second week of May. Okay. Gotcha. All right. Good, good, good. All right. So, all right. I'm going to go ahead and mute. Okay. Now it's getting a little noisy. So, all right. So let me mute everybody. All right. So we'll begin. Again, if you haven't registered, consider it. It's only $50. And with that, you also have access to me to ask me questions anytime. Okay. I'm not going to be recording this one tonight. I do have a couple already posted. I'm probably going to revamp this presentation and then I record another version and put it online. So any questions, pitch them out. Here in California, the test is 150 questions. A lot of other states is 150 questions also. Here, some of you may be from other states, but in California, you only need 60% to pass. Now, as much as it seems like, wow, 60%, that's like a D, you can like close your eyes and probably pick answers and pass. It's not an easy D. They do word the questions pretty different than how you normally speak, and so it is a little bit confusing. Um, so yeah, other states you need 70%. About 8, 10 years ago, it was 70% here in California. But there are some issues where they lowered the passing score rather than make the questions easier. Okay. You have 3 hours to do 150 questions. In California, we go to PSI exams. I think in other states also, you can register at psiexams.com, schedule your test. Make sure you show up 20 minutes early to check in. If you have an exam at 1 o'clock, that means you have to check in before 1 o'clock because your test begins at 1 o'clock. So you've already needed to have checked in by then. Make sure you do have proper ID when you take the test. If your driver's license expired 2 days ago, it's not valid. They won't let you take the test. So make sure it's up to date. Okay. Fingerprinting costs. Usually, when you pass a test, they have people on site to fingerprint you. We used to have two locations, the California Department of Insurance, where if you go there to take your test, it's only $50 for the exam and $58.30 for fingerprinting when you pass the exam. There's only two locations, Los Angeles and San Diego, that Department of Insurance still has open. Otherwise, everything else goes through PSI. PSI is an outside company that has partnered with Department of Insurance to give multiple locations. One of the things, the exam here in California is $83 if you go to PSI versus if you go to the California Department of Insurance site or CDI, it's only $50 to take your test. Likewise, the fingerprinting fee, they charge a little extra for fingerprinting. And so that's how they get paid is the markup. Okay. All right. So let's roll into this. This thing's acting up here. Okay, so you got to be prepared. You got to study. So if you think you can just wing it and go in there and take the test, good luck with that. Most people don't. Even though you only need a D here or C minus in other states, it's not an easy one. So be wary of that. It's technical. You have two right answers. One's just a little more correct, and you need to know the difference. All right. It's just a test, though. So one of the things is if you feel stressed, just take deep cleansing breaths. Just relax. It's just a test. You've got through many tests during your lifetime. This is just one more. Don't park if you realize you're stopping and you're reading this question 4, 5, 6 times. That's called parking, and you don't want to park. Okay, so read the answer, read the question, read the answers, pick the best guess, write the question number down on your scratch paper, and move on. At the end of the test, you can go back to any question you want. And if you that's the one that you may want to take another look at after you finish the test. Do not at the end of the test go back through the whole test because you finished early and start redoing the whole test. Just go to the ones that you were a little unsure on. Okay. Otherwise, if you go through the whole test, you're kind of tired and you don't see straight, and now you're going to change your right answers to wrong answers, and most people will typically fail because of that. Okay. If you get to a long question, it takes up the whole computer screen. Start at the bottom and read the answers first. Kind of take a look at what that question is getting into, and then just read the question right before the answers, which will probably say which of the following is correct or which of the following is incorrect. Okay. So start at the bottom. Don't use flag or skip or some locations that have mark for review. You either know it, pick your best guess, move on, or you don't know it. Again, still pick your best guess, put that question number down on your scratch sheet, and move on. Okay. So if you skip or flag or mark when you finish the test, you have to go back to a lot of those and you have to unflag it and click answer to finalize your answer. Otherwise, it's like a skip, and skip means you never answered it. And if you don't answer it when you close out the test, it's considered wrong. All right, so don't use those buttons. All right, go ahead and put your best guess in. All right, so even if you ran out of time, at least when they close out the test, your best guess is logged in, and that's what you got to. That's the part where you got to trust yourself. Don't trust me. Don't trust anyone else and what they say. Trust that you feel prepared, that you did put the time and energy to prepare yourself for the exam. When you're taking this test, watch out for the double negatives, the excepts, the nots. All of the following are incorrect, except which of the following is not unlawful. All right. So these are some of the tricks the test pitches at you, and you got to be wary of this. All right. Read the questions carefully. It's not really the material they're testing you on. It's making sure you can read the question correctly to know which answer you should be picking. Okay. So terms, insurance. Well, there's a couple definitions. Insurance is defined as a contract. Now, contracts in general do not have to be in writing. Insurance contracts have to be in writing. So that's kind of a key point, right? It's a contract to indemnify. To indemnify means to restore you to what you had before a loss, to make you whole again. Now, in life insurance, if someone dies, we can't bring them back. However, we can replace the income that they would have normally brought into this relationship if they were alive and still working and financially contributing to this relationship. Okay. And so you have to consider that. So it's a contract to indemnify you because of a loss due to an uncertain event. The loss must be uncertain. Okay. Now we know you're going to die. We're all going to die. That's a certainty. The uncertain part is we don't know when. So if you move to the front of the line because you came back from your doctor, found out you had 6 months left to live, and now you're trying to buy life insurance, that's a certain loss. And we're not going to insure that. Insurance companies will not touch that. Okay. So you got to buy it before that happens, right? Before there's a certainty. All right. So indemnity means to restore you to what you had before the loss. Insurance contracts are contracts of indemnity. In order to buy a policy on someone or something, you have to have what is called insurable interest. Insurable interest is having a legitimate economic or financial interest in the preservation of the life or the property that is the subject of the insurance. Okay. More simply put, in order for you to buy a policy on someone or something, if that someone or something suffers a loss, financially you are affected. So if you're not affected financially, there's no need to buy insurance. Okay. So you can insure your significant other, right? Maybe they're working and both of you are contributing financially to the mortgage, okay? And if something happens to them, you need money to help tie over or cover their side of the mortgage, right? As an employer, you can insure employees if they're vital to the success of the company. If your employee dies, you, the employer, would lose money in replacing their income that they would have brought to the company, but also hiring and training someone of their caliber, you see. So there is a financial interest there. A bank, if I lend you money, well, I can insure you so that if something happens to you, I get my money back. You see, these are things you need to look for. There is insurable interest engendered through love and affection by blood or marriage. A lot of times, grandparents buy policies on grandkids, right? But now, as your employer, they can insure you, the employee, but as an employee, you could not insure your employer, all right? Because if your employer passes away, well, you get a promotion, a raise, and you get the death benefit bonus from the life insurance you bought. And it's kind of a conflict. Okay, so keep that in mind. Now, as far as insurable interest in life insurance, you only have to prove it one time, date of application. Now, you might see date of application, you might see when the insurance goes into effect or at the onset of the insurance coverage. There's so many different ways of saying you only need insurable interest when the policy goes into effect. Okay, afterwards, it doesn't matter. All right. Now, in order to be the owner of a policy on someone, you have to have insurable interest. The beneficiary does not have to have insurable interest. The beneficiary can be anyone in the world. So you buying a policy on yourself as a single individual, you can name anyone in the world as a beneficiary. Yeah, so if something happens to you, they get the death benefit bonus paid in a lump sum that's typically income tax free. It's like them winning the lottery. How's that? Okay. Loss is defined as a reduction in the quantity, quality, or value of an asset. Okay. And for insurance, we have to have a financial attachment. Okay. What is the value of the loss? And so, in determining how much life insurance an individual may need, there's usually two different approaches that are very common. Number one, the needs approach. The needs approach is looking at the needs of the beneficiaries. How much money do they need to maintain their standard of living? The other approach is the human life value approach. So it's not looking at the needs of the beneficiary. It's looking at if this individual were to pass away, we're going to replace their future stream of income. So the human life value approach takes a look at how much do you make a year, times how many years to retirement, times the capitalized rate, which is the value of the dollars that appreciates over time. So if someone passes away, we can't replace them, but we can replace the income that they would have normally brought into this relationship. Okay, that's how that works. Okay, so there's two different approaches. There's one more approach, estate planning approach, and that's preserving as much of the estate so Uncle Sam doesn't get it. Okay. Again, there's your wealthy clients. Risk is defined as uncertainty of a loss. There's two types of risk, but when you see risk, look for the word uncertainty. Kind of goes hand in hand. But there's two types of risk, pure risk and speculative risk. Speculative risk would be like gambling. Okay? So as gambling, you could win money, you could lose money. You could break even. Well, that's the type of risk we don't insure. Pure risk is possibility of loss only. That's the type of risk we can insure. Okay? Because insurance is there to cover a loss, not to give you a gain. So even though you can simply afford a $2 million policy on, life insurance policy on a brand new baby, the insurance companies will say, no, 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 that's too much. Most companies only let you insure about 15 to 20 times your annual salary. So a newborn baby really doesn't even have a salary, let alone to warrant $2 million worth of life insurance on them. You see, so maybe you're going to kill your kid and get the $2 million and take that vacation you've been wanting. See, that's kind of a gain. And so they limit how much you can buy because it reduces the likelihood of fraud. Peril is defined as a cause of a loss. Now, if you're taking the property and casualty test, you're going to get tons of questions on perils. This one, you may get one. What is a peril? A peril is a cause of a loss. So cancer, AIDS, those are common perils. They cause losses. A hazard is a condition that would increase the likelihood of a peril occurring. So a hazard is like a catalyst to a peril. It increases the likelihood of a loss occurring. All right, so cancer is a peril, it causes loss. So a hazard would be like smoking, because by smoking you could increase the likelihood of getting cancer. So it increases the likelihood of major medical problems and possible early death. All right. No offense against smokers out there. In my honest opinion, I think you ought to quit, but don't quit on my account because nobody likes a quitter. All right. So I got to throw some humor in here. All right. So other types of hazards: a physical hazard, badly worn tires on your car. That makes it more likely for you to get into an accident. The next two, moral versus morale. You do need to know the difference between the two. Moral ends in L. Moral is where someone has a tendency to lie, cheat, be dishonest. Well, that's the world of auto insurance. People will lie to your face. You even tell them, hey, we're going to look it up, but I still got to ask you, have you had any tickets or accidents in the past 3 years? And they'll still say, well, no. And then you look them up and they've got like 8 different items. Okay. You'll still write them because they just got to pay higher premium. But that's an example of moral hazard. Morale hazard, which ends in ALE, think of more ale. When you drink more beer, you get careless and clumsy. A lot of people have that liquid confidence and they take more risk than they should. And that's kind of the mindset of a morale hazard, an indifferent attitude, a risk taker, someone who drives fast, engage in high risk hobbies, skydiving, scuba diving, auto racing, bungee jumping, spelunking, things like that. They're putting their lives at risk, which means they're more likely to suffer loss. Okay. Legal hazards are those people that are going for more money than they're legally entitled to. Where you might see this is someone who is healthy from a disability, but they malinger after a claim. Okay, so that means what they're doing is they're taking their time, dragging their feet, and going back to work because they're making the same amount of money sitting at home playing PlayStation as they would earn while working. Okay, that's a legal hazard. Someone trying to get more money than they're legally entitled to. That's how you want to view that. Okay. So select from the choices below the best description of a speculative risk. And as we just said, it's the possibility of loss or gain. You see, there's different ways of saying loss or gain. Right? This is the exam. So get the concept down. Speculative risk, same as gambling. You could win money, you could lose money. So you cannot ensure the outcome of the lottery. You cannot ensure the outcome of a sporting event, but you can ensure the liability at a sporting event because the liability means someone could suffer a loss. Okay, but the outcome, that means you could get a gain. The best description of a hazard is, and again, that's that condition that may increase the likelihood that a loss may occur or increase the likelihood of a peril occurring. All right. Choose from the following selections the best description of a premium. And premium is what you pay for the insurance. Now, if you read B boy, funds received by an insurer from an insured to realize the benefits of the policy. I mean, it sounds like it could be premium, but it's actually defining a deductible. Right? It's what you got to pay, like your health insurance. You suffer a medical problem, you got to pay a deductible before you receive the claim payment, which is the benefits of the policy. Okay, so the premium is what you pay for the insurance. You buy coffee by the pound, you buy gas by the gallon, you buy insurance by the unit. So 1 unit of insurance is $1,000. So in this case, if someone wanted $100,000 of this type of coverage, they take 100 times at $7, and that's what their annual premium is. Okay. All right. When is insurable interest required to exist with a life insurance policy? Remember, only at the date of application. All right. Not afterwards. In the property and casualty world, the auto, the homeowner's world, you actually have to prove insurable interest 2 times. When you buy the insurance and when the loss occurs to collect, but not in life insurance. You only have to prove it when the policy goes into effect. Right? Afterwards, it doesn't matter. This is where I joke around when I have married couples sitting in my class, So I joke with her. I said, well, if you bought a policy on him, you just need his signature at the date of application. And so I have her basically own the policy. He's the insured. And if he passes away, she's going to name herself as beneficiary. And so once he agrees to it, well, the policy goes into effect. Now, since insurance is a unilateral contract, once we, the insurance company, issue the policy, the insured, the policy owner, now controls it by simply paying the premium. After 2 years, there's only one reason the insurance company can cancel a life insurance policy. That's because the policy owner didn't pay the premium, or the insured. How's that? See, the client policy owner can cancel anytime they want. Just send written notice to the insurance company, not a problem. But as long as they pay the premium, the company has to live up to their end of the agreement, right, and cover the loss if the loss occurs. That's what we call a unilateral contract. It's one-sided. Okay. So after 2 years, if he commits suicide, well, she still collects because suicide is covered after 2 years. If he commits suicide during the first 2 years, we void the contract and we only refund the premium paid. Okay. So yeah. So you only have to prove it at time of death. So time of application. Sorry, the date of application. All right. So you buy a policy. 5 years later, they don't die. They divorce. They go reconcilable differences. Everyone goes their separate ways. 5 years later, right? As long as you keep the policy in force, 5 years later they pass away. Both of you are remarried, living separate lives. If that ex-spouse passes away and your policy is still in force, you still collect. See, so that's one-sided. You only need insurable interest at date of application. Afterwards, doesn't matter. Just keep the premiums going. Okay. Now, when you buy a policy, you typically buy it from a stock or mutual company. We're going to start with a mutual insurance company. Now, as a mutual company, any insurance company has to raise capital. Mutual companies raise capital by selling policies. And so you, the policyholder, here on the left-hand side, you're going to pay premium. Okay, let me get over here. You're going to pay premium. It's after-tax premium to the insurance company. They're going to do their accounting, and they realize, hey, we charged a little too much money. We made a profit, so we're going to give that back to the policyholders, and we're going to call it a dividend. Now, the dividend itself is non-taxable. Dividends are not paid monthly. They're typically paid quarterly, but dividends are never guaranteed. Okay. And so we define dividends to a policyholder in a mutual company as a return of excess premium paid. All right. And so mutual companies issue what's called participating policies, because if you buy a policy, you participate in the profits, which are those dividends. Okay. So anytime you see participating associated with mutual, anytime you see dividends paid to a policyholder associated with a mutual company, not a mutual fund, a mutual insurance company. All right, there's a difference there. So a sample test question, Sam's insurance policy pays a dividend. See, there's one telltale sign. The agent that sold Sam the policy refers to the shareholders of the company as participating. So there's another telltale sign. Therefore, it is a mutual insurer. Okay. The other type, the biggest competitor of a mutual company is a stock insurance company. Now, when you hear a stock insurance company, that means this particular insurance company raises capital by selling stock, which is ownership in the company. Now, as a policyholder, you're still using after-tax money to pay for the policy. It goes to the company, they do their accounting, and if they make a profit, that profit's going to go to the owners of the company, which are the shareholders or stockholders. That means stock companies issue what's called non-participating policies, because you, the policyholder, do not participate in the profits or dividends. The profits go to the owners. Okay? So, yeah. So now some of you are thinking, well, I want to buy from a mutual company because I get dividend back. Well, realistically, over the long run, there's no difference. All it is just two ways of raising capital for an insurance company, either by selling policies or by selling stock. Okay? So, a mutual company may charge you $10 a month and give you $2 back on the next quarter in the form of a dividend, versus a stock company may charge you $9 a month and we call it even. Okay. So again, over the long run, there's really no difference. Okay. So they might change this around. Sam's insurance policy does not pay a dividend. The agent that sold Sam the policy refers to the policy that the company offers as non-participating. See, so there's some key words there to help determine that this is a stock insurance company. Okay, non-participating stock, participating, think mutual. Okay. Now, if a mutual company converts into a stock insurance company, this is called demutualization. All right, so very common test question here in California. Okay, demutualization. All right, so yeah, it's kind of a private company that decides to go public and be a stock company and traded on the stock market. Then yeah, they demutualize. Okay. So Julie is a licensed insurance salesperson who represents the Silver Dollar Insurance Company. If you were to look at the front of her office, you would see a sign that reads Silver Dollar Insurance Company and then Julie Insurance Agency. If Julie performs acts that are not specifically named in the written contract that she has with Silver Dollar, she's exercising her implied authority. Now, the key here is she's doing acts that are not specifically in writing. So not in writing means implied. Now, if they change this up and she's doing stuff that is specifically in writing, that's express. So express in insurance means in writing, and implied means not in writing. Not verbal, just not in writing. So keep that in mind. So if you buy a life insurance policy, right, it is expressed in writing that if you die, we're going to pay your beneficiaries the face amount or death benefit of the policy. Okay, that's in writing. That's expressed. What's not in writing is how you died. It doesn't say you have to die a certain way to collect. You see, it's assumed under the contract that if you die, your beneficiaries get paid. Okay, does that make sense? So yeah, be wary of that. The federal act that mandates that a credit reporting company responds to a consumer complaint when the company's credit report inaccurately reflects information about the consumer is the Fair Credit Reporting Act. Now, this one, they might change it just acronyms, FCRA. All right. Fair Credit Reporting Act of 1970, you might see. They might even throw a year in there. Okay. But again, if you have a blemish in your credit report, you can request a credit reporting agency to investigate it and clean it up. And that's free of charge to you as part of your right under the Fair Credit Reporting Act of 1970. Okay. Now, the top one, HIPAA, excuse me, HIPAA makes sure that private information is kept private, but it's also the word portability. That means if you go from one group insurance program and within 60 days get hired by another group insurance program, well, they typically have to add you to the new group insurance health benefit program on date of hire. As long as you go from group to group within 63 days. Now, this is not conversion. This is not COBRA. All right, this is you left a group and got picked up by another group that has a benefit program within 63 days. Okay. Omnibus Budget Reconciliation Act, or OBRA, right? There's two parts to this. Number one, it extended the COBRA benefits for certain qualified people. If you were terminated from employment with a disability, OBRA gives you 11 more months to stay on COBRA. So instead of just 18 months, if you're disabled at time of termination, OBRA gives you 11 more months, so you have 29 months to be on COBRA to get before you get on a new program. Okay. And Tax Equity Fiscal Responsibility Act, TEFRA, oversees your qualified programs. Okay. All right. So yeah, these are all federal acts. Agents versus brokers. A lot of people mix this up. If I'm roaming around aimlessly in public, people ask me, well, what do you do for a living? I say, I sell life insurance. And in the real world, they say, oh, so you're an insurance agent. In the real world, you can call me anything. Just buy my policy, and I'm happy. But in the test world, that would actually be wrong. An insurance agent does auto, homeowners, commercial workers' comp. I'm a life agent because I sell life insurance and or disability insurance. Okay. Now, in the public, if I say I sell life insurance for multiple insurance companies, in the real world, people say, oh, so you're a broker. And in the real world, remember, you can call me anything. But the test world, no, we don't have brokers in life insurance. Okay. So insurance agent, insurance broker, that's on the property and casualty world. As an agent, you represent the insurance company. As you see these arrows, an agent, the company contracts your services as an insurance agent, and your job is to sell insurance to the client or the public. Now, a broker is the other way around. Brokers represent the client with, but not on behalf of an insurance company. Brokers charge a fee, whereas agents get commission. The easiest way to understand this is you represent whoever pays you. As an agent, the company pays you commission, so you represent the insurance company. Your job is to sell to the public. But as a broker, you charge a client a fee, so you represent the client with, but not on behalf of an insurance company. And so brokers represent the client and place business with insurance companies. So between insurance brokers and insurance agents, if the test question says which one sells insurance, only agents sell. Brokers don't sell. Brokers secure coverage or brokers procure coverage on behalf of a client with, but not on behalf of an insurance company. You see, this is that funny language that the test uses, okay, just to try and confuse you and make you kind of scratch your head going, what are they asking? All right. So through repetition, you'll pick it up whether you want it or not. So as far as agents, we have the insurance agent on the left side, which is what we just talked about. Remember, that's the auto, the homeowners. They can do everything except life and or disability. And then we have a life agent, which in California we have. It can be broken up to life only and the accident and health only. All right, but you can get them both at one time, and that's the life agent license. So it allows you to do life and or disability. Now on the test, remember, whenever you see disability insurance, think health insurance. Disability insurance is a broad topic. It includes all the health policies as subcategories. Okay, so agents sell to the public. So the California Insurance Code cites a specific definition for a life agent. A life agent is, and it's going to be none of them, because A and B do not sell life. Remember, that's the auto, the homeowners people. A person authorized to aid an insurance agent, well, if an insurance agent does property and casualty, then you're authorized, if you're aiding them, then you're going to be selling property and casualty, not soliciting life insurance. Okay, and so that's what that's about. Some other items, a life and disability insurance analyst, just think that they're just a fee-based consultant. They sit with a client, they review their situation and give them advice based on a written fee. All right. And yeah, that's all it is, a fee-based consultant. I'm going to review your income, expenses, investments. I'm going to tell you this is how much insurance you should have. This is what kind you should have. Now pay me my fee based on this written agreement. And my job is now done. Now you can go buy from a life agent and place that policy. Okay. As a life and disability insurance analyst, you do need your life agent license first. This is another exam that you can get to be a fee-based consultant on the life and health side. Okay, very few in the state of California, apparently. A third-party administrator. Well, if you ever worked for a company where your benefits department was a whole nother company and they kind of took care of things, that's a third-party administrator, or TPA. Okay, and so they basically collect premiums and pays claims on behalf of your employer in dealing with life insurance, annuities, and disability or health insurance. In order to be an administrator, you need to have a certificate of registration with an insurance company to act as an administrator. Okay? So just think it's an independent firm that your company pays fees to run the benefits program for them. Okay, so the third-party administrator is not another license, right? The life agent license with a proper company and a certificate of registration, you can become an administrator, a TPA. Okay. Of the items listed below, which are requirements for a life and disability insurance analyst license? It's all of them. You got to have good reputation, you got to be of legal age, and you got to be knowledgeable. Okay, so they're all. They do test your knowledge by throwing another test at you. Okay. Which of the following is correct about a third-party administrator? And it's an independent company that provides administrative services for self-funded programs. To truly self-fund, as an employer, you're not buying insurance. You as an employer, mid to large-sized companies can do this, right? Instead of buying insurance, you're just going to set up an account, put money in this account, and you're going to pay your employees' medical bills out of your company's assets. Okay? So a large company with a lot of predictability, that's fine. You only want to self-fund if the worst case scenario is known and you can afford it. Okay? But if you don't know what you could lose, then you don't want to go that route because insurance companies are more capable and financially able to handle catastrophic claims. All right, so that's where you might want to buy insurance. But Oracle over here in Redwood City, when they first started out, they actually did self-fund. They didn't buy health insurance for their employees. They basically covered all their employees' medical bills out of their company's assets. All right. But if they had a couple employees suffer some catastrophic losses, well, they don't want to go bankrupt paying for these claims. And so a more subtle way of self-funding is, why don't we set up a group insurance program with a high deductible? And the employer provides the money for the deductible. So if you had a group, mid-sized group, and you had a $2 million deductible, remember, by raising your deductible, it's going to lower your premium. Okay, so you take care of the first $2 million in claims during the whatever period of time you choose. Once you pay $2 million in claims, the insurance company covers the rest, which keeps your company from going bankrupt. Okay, those are self-funded plans. Okay. According to state law, what size print must be used for the licensee's license number on all price quotes, business cards, and printed material? It's the same size as your phone number. So if you're going to give someone a business card, Your license number must at least be the same size as your phone number on that business card. So if they can easily read your phone number to call you up and buy insurance, they should be able to easily read your license number to turn you in if they have a problem with you. This is called accountability. So Ben is a life agent. He'd like to do business with the Rock Solid Insurance Company, but he doesn't have an appointment to sell their policies. Assuming Rock Solid does not require exclusive representation, can Ben submit an application to them from a prospect? Sure, he can. And if that company accepts the application, they now have to appoint Ben as an agent within 14 days. So this is called solicitation prior to life agent appointment. So at the first line, Ben is a life agent. That means he's already licensed to walk the walk, talk the talk. He just does not happen to represent Rock Solid Insurance Company. So if he gets a hold of an application from Rock Solid, has the client fill it out, submits it to Rock Solid, if they accept the application and issue the policy, they now have to appoint Ben as an agent. All right. Now, when you do this, don't take premium, because if you take premium, you have to give a binding receipt or a receipt. If it's a binding receipt, that means you're binding coverage for a company that you are not an agent for, and that's illegal. And if you get caught binding coverage for an agent or for a company that you're not an agent for, that's automatic license suspension. Okay, so be wary of that and don't fall into that trap. Okay. Assuming continuing education requirements have been met, how is your license renewed? Well, 90 days before your renewal period, the Department of Insurance sends you a notice saying this is how much continuing education you need to do. And these are the renewal fees to pay before this deadline in order to renew your license. And as long as you renew it, even if it's on the last day, you can still transact insurance for 60 days while waiting for the new license to be issued to you. Okay. Usually it's pretty instantaneous. All right. But as long as you submit everything and if Department of Insurance is backed up, you can still sell insurance for 60 days while waiting for the new license to be issued. As long as it was in a timely fashion. If you did not renew, in California, it's a 2-year period. If you did not renew your license within 2 years, that means you have 1 more year to renew it, but there's a 50% penalty on the renewal fee. Now, if you don't renew it by the 3rd year, that means 2 years is what your license is good for. 1 more year to renew it and pay a late fee. And if you don't renew it by the end of that 3rd year, you start from scratch, have to apply, take, and pass your test all over again. Okay. So don't let it lapse. All right. Excuse me. This page has a lot on it. All right. So when I'm sitting with a client, I'm going to start with the top right-hand corner. When you're sitting with a client, you're asking them questions on the application, and they're going to answer you with representations. So how are you feeling today? No, I feel good. They told me orally that they feel good. I put it in writing on the application. It's still a representation. To their best knowledge and belief, they feel good. That's what a representation is all about, the best knowledge and belief. All statements made on an application are representations. Okay. Now, so we're asking them questions about, has anyone in your family ever had any major health issues? And they say no. To their best knowledge and belief, they didn't know they had an uncle that had diabetes. You see what I mean? And so we're trusting what they see is true and correct, and that's what we're going to put on the application. Now, the application has 3 parts. Part 1 is general information, name, address, things like that. Part 2 is the medical questionnaire. It's not that you're giving a client a medical exam. Let the professionals do that. You're just asking the client questions about their past medical history. Like, when's the last time you went to a doctor or hospital and why? Okay, because we want to know a little bit about that. Okay. Now, if you're not sure how to broach the topic, then put it on your agent's report. That's part 3 of the app. Only the underwriter and you see the agent's report. The client will never see that. The agent's report is going to ask you questions like, how long have you known the proposed insured? Do you know if they drink? Do you know if they smoke? Do you know if they participate in high-risk hobbies? Are we insuring the children? Have you seen the children? Do they look healthy? Okay. Is this a replacement issue? Is there anything else we, the underwriter, need to know in determining whether or not to issue a policy for the proposed insured? And so if you saw something at the client, dealing with the client, and you didn't know how to broach it, then write it on your agent's report. Because a lot of times the underwriter will actually telephone call the client and gather more data. Okay. But me, if you're gonna lie to me, yeah, I'm gonna call you out on it. That's just how I am. All right. So so maybe you pull up in front of their house and taking a drag off a cigarette on the front porch. Okay. You're doing a home appointment. They take one more hit. They see you, come inside. When you go inside, they live alone. Ashtray full of cigarette butts in the middle of the dining room table. My eyes start watering when I go into a smoker's house. They have a pack of Marlboros rolled up under their shirt sleeve on their T-shirt, right? And then they want to buy the policy, and so you can go into the questions and you ask them, "Do you use any tobacco product?" And they tell you to put no down. Okay, well, if you don't want to call them out on that, then write it on your agent's report. Okay. So, but remember, as an agent, you represent the insurance company. So you kind of need to represent the company's side and take the stance and call them out on it. Or another way of managing it is you don't want to call the client a liar, right? But if you saw him take a drag off a cigarette as you walked up to the house, right? Then when you go in and start doing the app, don't ask them if they smoke because you know they do. Just ask them, how often do you smoke? You don't give them an out. So you're kind of reducing the confrontation. Give you some outside advice here. So the application has three parts. Now there's a middle part here, this non-medical application down here. For the test, whenever you see non-medical app, it doesn't mean we don't do a medical. The key word with a non-medical app is we may still do a medical. And so let's say we have 5 knockout questions that we ask you, and as long as you say no to all 5, we do a quick background check, and everything's good, well then great, policy's issued. But if you said yes to one of those questions or you said no in our quick check, we kind of determined something else showed up, it may lead to further underwriting. So watch out for the exam. A non-medical app doesn't mean we don't do a medical. It means we may still do a medical. Okay? All right. So now over here on the left-hand side, a policy has 4 parts, and you can use these abbreviations, TICE, TICE. Okay. The title page is the first page of the policy. Periodically on the exam, you're going to see it called the policy face. So title page, policy face, it's interchangeable. Okay, basically tells you which company you bought from, and then the face amount of the policy and the type of coverage, which is actually number 2, the insuring clause. Excuse me. For the exam, the insuring clause tells you the type or kind of policy you bought. It's usually a paragraph at the bottom of the title page. That this is a non-participating, whole life policy to age 100, blah, blah, blah. Okay, so it tells you what type or kind of policy you bought. Now, you might see insuring clause, you might see insuring agreement. It's clause and agreement is the same. It's interchangeable. Remember, this test goes a little crazy with the thesaurus, so watch out. All right. All right. The conditions clause or conditions agreement spells out the obligations. So the conditions clause is going to tell the client, this is what you need to do to collect from the policy. Okay. So for the test, they typically use it spells out the obligations. How the clients are obligated to show proof of loss, and insurance companies are obligated to investigate, settle, and pay the claim. Okay. That's the conditions clause. And the fourth part of a policy is exclusions, and that's real simple. It tells you what's not covered. Okay. Sometimes military action, aviation risks, and suicide in the first 2 years not covered. Okay. Excuse me. I got this like tickle in my throat that just doesn't seem to go away. All right. So the application and the policy together make up what is called the entire contract. That's a common test question. The entire contract provision consists of which of the following? And it's the policy and when attached the application. Okay? So in the property and casualty field, we don't have that. But in the life and health, the application is usually photocopied and attached to the back of your policy. Oh, excuse me, I really apologize for this. All right. Now, statements in the policy by the insurance company are typically warranties, which is the top left-hand corner. So warranty is defined as a statement of fact that must be the exact truth. And like I said, there's 2 types of warranties. Whenever you see the word express, it means in writing. And whenever you see the word implied, it means not in writing. Okay? So, yeah, keep it separate. Whereas a representation may be oral or in writing. Okay? So representation may be oral and writing. Warranties are express or implied. Don't mix them up. Warranties will not be oral or written, and representations will not be express and implied. However, a representation may qualify as an implied warranty, but a representation will never qualify an express warranty. Okay, so that's kind of some weird terminology the test uses, so be aware of that. If you go through my sample test questions on my website, then you'll get used to that terminology, and you'll be able to spot it. Okay. So now the bottom left-hand corner, no, transacting. You can use these acronyms: SNET, solicitation, negotiation, execution, and transaction of matters. Okay. So solicitation is advertising, marketing, trying to get the client to meet with you. Okay. Negotiation is you're actually chatting with the client. They're requesting, can you email me some more information? But you're negotiating, trying to get them to buy the policy. Execution is they actually buy the policy and you're putting it on the books. And then the transaction of matters subsequent to execution of a contract of insurance and arising out of it, that means once the policy is on the books, now you're servicing it. That's what that last one is about. Okay. You know, adding riders, maybe adding a dependent, adding a child, changing beneficiaries. You typically can't do any one of those unless you have a license. Right? Transacting without a license is a misdemeanor and a $10,000 fine. So be wary of that. Now, parts of a contract, this is contracts in general, not an insurance contract, just contracts in general. So remember, contracts in general do not have to be in writing, but insurance contracts must be in writing. So consideration is actually defined as an exchange of value. Clients actually give two things of value. Number one, premium, because money is valuable. Number two, personal information on the application. You know, name, address, social security number, driver's license, right? That's some pretty valuable stuff. Now, the company has to give something of value back to the client in this contract, and it's a promise. We promise to pay should you suffer loss according to the terms of our contract. So it's the act of filling out the application, paying the premium for the promise of receiving benefits. That's what consideration is in insurance. That's our exchange of value. Legal purpose, well, you might see legal purpose or sometimes legal objectives. Legal purpose means you're buying the insurance to protect against a loss. Right? But another way of saying that, instead of protecting against a loss in insurance, it means you cannot get a gain. So be wary of that. Right? You're used to studying one way. You know, let's say you have a yellow highlighter, and that's all you're taught. This is a yellow highlighter. This is a yellow highlighter. This is a yellow highlighter. Okay. Then when you go take the test, well, you know what a yellow highlighter is, huh? And then you take the test, and they say this is not a green car, and you're looking for a yellow highlighter, and there is none. But this is not a green car is another way of saying this is a yellow highlighter. You see, and so you're so focused studying one way, and the test hits you with the question from the other side where you kind of don't recognize what they're even saying. So be wary of things like that. So legal purpose means you cannot get a gain, all right? Or you're protecting against a loss. There's two ways of saying the same thing. Agreement is broken down into offer and acceptance. In insurance, who makes the offer? The insurance company through you, the agent, especially life insurance. You have to convince people that they should buy it, okay? And so you're offering to sell them insurance. They're agreeing to take your offer because, yeah, you're right, I do need insurance. So they fill out the application, pay the premium, and they give it back to you to present to your company. Well, this is actually a counteroffer. Here's the information you requested. Can you insure me at what you put in your proposal? Okay. And so the insurance company accepts this counteroffer. They underwrite it and they say, oh, wow, they got this medical problem, so we can insure them, but we have to charge them a little higher premium. Go back and ask them if they still want it. This is another counteroffer. And the client can choose to take it or leave it. Okay. And if they choose to take it, then that's great. So it doesn't matter who makes the offer. Both parties have to agree to the conditions in the contract. That's when we have agreement. Okay. Competent parties, use your right mind. They got to be mentally competent. They cannot be a minor. Okay. Cannot be intoxicated or under the influence. Right. Cannot be deceased. And what's a weird one is they cannot be a public enemy. Right. So you cannot sell life insurance to someone who's armed and dangerous and wanted by the law. Right. So if for some reason the police apprehend them, shoot and kill them, and their beneficiaries make money from that deal, that's kind of a conflict. Okay. So there's quite a bit just on this one page, which is part of the general insurance concepts on your test. So make sure you get that down. Okay. Employees that have group life or health policies covering them are required to be issued a certificate. So, yeah, if your employer has an employer-sponsored program and you're going to be getting the health insurance on that program, you're given a certificate to show you are part of the plan. But your employer is the master policy or master contract holder. So your employer is setting up a group program for the benefit of the group. So again, the employer is a master policy or master contract holder. Employees get a certificate to show that they're part of that master policy. OASDI, every once in a while you see OASDHI. This is the original name for Social Security, Old Age Survivors and Disability Insurance. How's that? Originally acted back in 1937 to provide retirement benefits. To be eligible, you have to pay in the Social Security system and achieve what is called fully insured status, which is paying in for 40 calendar quarters. Okay, that's basically 10 years. Now, on your study material, you'll probably see 40 credits, but when you take the tests, they typically use 40 quarters. So it's the same thing. So 4 quarters in a year. If you work that whole year and paid in Social Security, you earn 40 or 4 credits, okay, or 4 quarters. So 40 quarters would be paying in for 10 years. Okay. Now, when you're eligible for benefits, it totally depends on when you were born. For early retirement, you can take early retirement and get 60. If you want to take early retirement, under Social Security, you can take early retirement at age 62, but you only get 80% of your normal retirement income benefit. Okay, so you'd have to postpone retirement to age 65 or 67, depending on the year you were born. So I'm in my 50s, and so yeah, I have to wait to age 67 to receive full retirement benefits. Okay, so it's based on when you were born. In 1939, they added survivors benefits. There's 2 benefits. Number one, we have a lump sum of $255 for the cost of burial. And then we have income benefits to your surviving spouse if they have minor children. So if you die, your surviving spouse has no minor children, well, they only get the lump sum to cover the burial. But if they have minor children, they will receive income until the youngest child turns 16. Once the youngest child turns 16, Social Security survivors' income benefits end. However, as a widower, your surviving spouse can take early retirement at age 60 and start receiving benefits for retirement then. Okay, so no more early retirement at age 62, but if they're a widower, they can take early retirement at age 60. Okay, still 80% of the benefit though. Now, that period of time from when your youngest child turns 16, but before your surviving spouse turns 60, there are no Social Security survivors' income benefits payable. This is called the blackout period. Okay, so you got to know what that is. All right. Now, disability under Social Security, which is the most restrictive definition of a disability you'll ever see. If you do suffer disability, you apply. If you qualify, there's still a 5-month waiting period. That means when you apply, you get approved, you got to wait 5 months to get the first check, right, for disability income. How's that? But you got to meet that definition of disability, as you can see the next 2 bullets here. Social Security is the most restrictive definition. Basically, if you cannot perform any substantial gainful work activity due to physical or mental impairment, that disability must last at least 12 months or is expected to end in death, then you can qualify. Okay. But honestly, if you could still, make French fries at McDonald's and earn a living, you wouldn't qualify under Social Security. It's very restrictive. Okay. Now, another part of Social Security is the Medicare program. Now, Part A that covers the hospital, and you earn that because you paid into Social Security. So that's free for most people because you paid into Social Security. Part B covers the doctor and the surgery, and you got to pay premium for Part B. Okay? So there's an annual enrollment period. You might see AEP or OEP, open enrollment period. Usually the first quarter of every year you can sign up. Okay. So Part A, just think of it, covers the bed. There's deductibles, and then when you're in the hospital, there's some copays. All right. So there's every time you go in, you got to pay a deductible. It's a little over $1,000, I think now, and then a copay when you're going in. So you get 90 days of inpatient stay. That means 90 days in a semi-private room. All right. The first 60 days are going to be free after you pay the deductible. The 61st through 90th day, you have a daily copay. Now, if you use up those 90 days, well, then you have 60 lifetime reserve days to dip into, but that's a higher copay. So that's being in a hospital in that semi-private room. Let's say you come out of the hospital, but you can't quite go home, so they're going to place you in a skilled nursing facility. Medicare gives you 100 days in a skilled nursing facility. Right? You got to be hospitalized for 3 days first, and there's got to be an expectation of getting better. Okay, so Medicare Part A provides limited long-term care. Right? You get 100 days in a skilled nursing facility. Okay, then you're able to go home and maybe having occasional visits from a home health aide. Home visits from a home health aide are covered. No limit to the number of covered visits. Right, and then if you don't get any better, well, then you go into hospice, which is for terminally ill. And Medicare provides benefits for hospice. Right, much needed institution. You got to know the definition of hospice. It's a facility designed to control pain and suffering for terminally ill patients. It doesn't treat diseases or attempt to cure anything you have. Just dope you up with painkillers to help you die with as little pain and suffering as possible. That's basically hospice. I'd call it your final hotel stay. All right. So now that's Part A, which is the bed. So when you're in the bed at the hospital, well, then Part B could kick in where it covers the doctor that visits you. So there's a deductible, changes every year. You don't need to know the dollar amount. But once you pay the deductible, now you're going to share in the cost of your claim with Medicare. And it's an 80-20 coinsurance. Medicare pays 80%, you pay 20% of what's called the allowable charge. So the actual charge, let's say it's $10,000 for procedure, okay? The UCR, usual, customary, and reasonable charge, is the average rate for medical procedure in the area you live in. So let's say the actual charge is 10 grand. The UCR charge is 8 grand. Now that's what your normal health insurance companies are going to pay for the type of care that you got. The allowable charge, let's say it's 6,000. Okay, and so based on Medicare, their guidelines. So Medicare pays 80% of that 6,000. You pay 20% of that 6,000. Okay. Now doctors that don't accept what Medicare pays directly as payment in full, they can't gouge you. There's a Physicians Reform Act that says the maximum the doctors can charge you if they don't accept Medicare is 115% of what the Medicare allowable charge is. Okay, so take that 6,000 times 1.15. That's the maximum they can charge you if they're not a Medicare provider. Okay. Now, what I have at the very bottom corner under Part B here is Part B may be appealed. What that means is what part of Medicare may be appealed? Part B. See, Part A, your benefits are cut and dry. There's your number of stays, number of days that we cover you, right, and how long we're going to cover you. And that's basically it. There's no debating, okay? But Part B, you pay a deductible. It's 80-20 of the allowable charge. So if Part B says it's not covered, and you think it should be covered under Part B, you can appeal it. So there is an appeal process for that. Okay. So make sure you understand. Part A cannot be appealed. Part B may be appealed. Now, Part C is where private insurance companies come in and they partner with Medicare. You earn Part A, you sign up, you pay premium for Part B, and then what you do is you trade it in for Part C, which is Medicare Advantage. You pay an additional premium, but now instead of having that program that Medicare Part A and Part B have, now you have HMO PPO as a senior. Okay. So that's basically what it is. Part C is private insurance companies partnering with Medicare and providing HMO PPO for Medicare recipients. Okay. Now, what competes with Part C is Medicare supplements. Sometimes these are called Medigap policies because they're designed to fill gaps left by Medicare. Medicare has parts A, B, C, and D. Medicare supplements have plans, A through N. So yeah, there's 14 plans. And every plan must contain what's called the core benefits. The core benefits are the minimum benefits that a Medicare supplement policy must provide in order to call it a Medicare supplement policy. All right. These core benefits kind of fill the gaps left behind Medicare. So let me back up. If you had a Medicare supplement core plan, let's say you had Plan A, which is the core plan, okay? Plan A right here. That's the minimum benefits, which we call the core plan, okay? And I use these abbreviations, CORE. So let me go back to Part A and B. So the C covers your 20% coinsurance for Part B. So if you had a Medicare supplement on the core benefit plan, right, the basic plan, Plan A, would cover your 20% coinsurance. So under Part B, you just have a deductible, and then Medicare covers 80%, and your Medicare supplement covers the 20% that you typically would pay. Okay. Your inpatient days, you get 90 days in a semi-private room. The first 60 days are covered. The 61st through 90 days a daily copay. And so your Medicare supplement can actually cover that copay for your 61st through 90th day in the semi-private room. So basically now you have 90 days free of being in a semi-private room getting care. All right. Neither Part A or Part B provide red blood, the first 3 pints per calendar year. And so if you had a Medicare supplement policy, the R stands for this will actually provide the first 3 pints of blood per calendar year. Okay. And then the E, well, whoops. If you use up your 90 days, you get 60 lifetime reserve days. Now, these are additional days to dip into, like a reserve bank, but you only get 60 days from age 65 till you die. That's it. And so your Medicare supplement plan, the E, gives you an extra 365 lifetime reserve days to dip into. So it gives you a whole year of additional days to dip into if you still need it in case you have extended hospital stays. Okay. There is an open enrollment period. Okay. When you first enroll in Part B, Medicare Part B, you sign up and pay premium for Part B. You have a 6-month window to buy one of these policies without a medical exam. Okay. All right. So that's Part C. Remember, this is private insurance companies. Then Part D, we go back to the federal program providing prescription drugs. So D for drugs makes it easier that way. Okay. So remember, Part A is the bed, Part B is the doctor and surgery, right? And Part D is the drugs. That's the federal program. Part C is private insurance companies. Okay. So in the life insurance planning process, the blackout period is considered. And remember, that's that period of time where your surviving spouse does not get any income benefits. Okay. Remember, it begins when your youngest child turns 16 and ends when your surviving spouse turns age 60. That's the blackout period. All right, so classes of life insurance. Now, whenever you see classes, it actually means types of insurance. All right, and there's approximately 20 classes of insurance that may be offered to the public. Life insurance is one class, but we have a smaller breakdown of 4 different classes of life insurance. Sounds redundant, but it is what it is. Industrial life. These started during the Industrial Revolution, where the whole town worked at the factory. Well, this agent would knock on your door and collect premium from you directly from home or work, usually weekly, sometimes monthly. So there's frequent premium payments, like I said, usually weekly, sometimes monthly, collected in person. Now, the geographical area where the industrial life agent collected premium from, this is called a debit. And so you hear the phrase debit plan. All right. The maximum face amount of an industrial life policy is $10,000, but most people only bought $1,000 to $2,000 because that's all it costs for burial. Okay, family members are covered from birth age 65 or 70 without a medical exam. Right, so it's a limited policy just to cover burial. Right? And it was sold way back during the Industrial Revolution. We still have industrial life policies today. They still make up about 1% of insurance in force. Whenever you see ordinary insurance associated with, that's an individual policy. Ordinary and individual life are interchangeable. Okay. Group is where insuring groups could be employer-employee group, which is the most common, but it also could be association or labor union group. All right. Credit, we have credit life or credit disability. Credit life, if you die, we pay off the debt, whatever the debt you have. But if you suffer a disability, we'll just make the minimum monthly payment to your creditors while you're disabled. Then hopefully you come off a disability and just pick up where they left off. Okay. So these are different classes of life insurance. So all the following are reasons for an individual to purchase personal life insurance except, and that's to cover a buy-sell agreement. Buy-sell agreement is going to be work-related. Okay. So you have two partners and they insure each other. So if one of the partners dies, the surviving partner now has money from the insurance to buy out the deceased partner's interest from their family members and keep the business intact. Okay. Very common. Why would a business use key person life insurance? Well, because we need to protect our company in case our executive passes away. Number one, we need money for lost revenues, right? Number one. Number two, we need money to hire and train a replacement of their caliber. And so we have key person life insurance in case they passed away, but there's also key person disability where if our executive was disabled, this provides the company with money, again, to hire and train someone of their caliber and take that position. Okay. And hopefully that person recovers. Identify the statement that is true about contributory group life. Well, contributory means the employees have to contribute some of the premium, either some or all the premium. Maybe your employer just set up the group insurance program, but the employees have to pay the premium for it. All right. So don't confuse this with participating and non-participating. Right? Participating, non-participating deal with whether you're buying from a stock or mutual insurance company. But contributory, non-contributory deals with who pays a premium on your employee benefit plan. If it's a contributory plan, then you, the employee, have to contribute some of the premium. So your employee benefits aren't free. But if it's a non-contributory plan, then as an employee, your benefits are free. So it's in the name. You do not have to contribute premium. All right. So that's kind of nice, huh? Few and fewer companies are doing that. All right. Now, going back to contributory, non-contributory, in order to have a contributory group program, you got to have at least 75% of your eligible employees on the plan. Now, if you ever see non-contributory plan, you got to have 100% of your eligible employees on the plan. Okay. This protects the insurance company from setting up a group insurance policy and only the high-risk employees are getting on the plan. So by having at least 75 or in a non-contributory plan, having everyone covered by the plan, not everyone suffers losses. And so the premium income from those that don't suffer losses help cover the claims for those that do suffer losses. It protects the insurance company from a term called adverse selection. Adverse selection exists when you have a bunch of high-risk people trying to seek and get insurance coverage more often than a normal risk would. Okay. So, yeah, and so we got to weed that out. That's what we call field underwriting. Okay. Some of the questions are a little tricky. Jamie is an office manager. She fell off a horse while visiting her mother on vacation. So this rendered her completely paralyzed. Now, after a year, the doctors feel she will not recover from her injuries. Choose from the selections below the program from which Jamie will be able to collect disability income benefits. So when you see office manager or office employee, you're inclined to pick workers' compensation. But if you read this first sentence, she fell off a horse while on vacation. So it's not workers' compensation at all. Now, A and B are both health care programs. Medi-Cal is health care for medically needy, medically indigent. Okay, it's where the state and federal government work together to provide a socialist type health care for people who cannot afford it. It's called Medi-Cal in California. It's called Medicaid in most other states. Okay, but it's not providing income. It just covers your medical care. All right, Medicare again provides medical care, so it doesn't provide income. So that means it eliminates the top three, so you're left with Social Security. Well, she's going to be disabled for the rest of her life, then she'd probably qualify under Social Security. So your answer is Social Security. Okay. And again, so read the questions carefully, even though it says office manager or office employee. Find out where the injury took place. If it's not on the job, then it won't be workers' comp. Which of the following supports the Medical Information Bureau and its insurance companies? I'd say 99% of your life insurance companies and about 85 to 90% of your health insurance companies financially support the MIB. So what this is, it's a nonprofit trade organization that collects data from insurance companies and certain doctors and hospitals about your past history. So anytime you bought an insurance policy, life insurance I'm talking about, or health insurance, anytime you were issued a substandard policy, or anytime you were rejected for coverage, or if you filed a claim with certain doctors and hospitals, it's going to go on this report. For the test, in case you get those questions, it gives you a 3-year history of your past medical background. Okay. Number one. Number two, you can request a copy, right? You can basically, I think it's like $7 or $9. You can get your own copy. Okay. Number two, right? Number three, I guess, right? And then another thing you need to know is you cannot be declined for insurance based on information on the MIB. This just tells the underwriter where to look. See, in taking an application, we're going to ask you when's the last time you went to a doctor or hospital and why. You tell us, okay? Or you don't tell us. Well, if you don't tell us, or whether you do tell us, the underwriter gathers the application. They're going to look at the MIB, which everything is in code form. And if they have the code, they can access it. And they say, hey, wait a minute, this person went to a doctor on this date. Now, you said you just went in for a checkup. Well, we're going to go talk to that doctor who saw you on that date and get their side of the story. And if it's serious enough, well, they can reject you. Now, this information from the doctor, because we need more information, is called an attending physician statement. So you cannot be declined for coverage based on information on the MIB, but it can tell the underwriter where to look. And if that attending physician statement is serious enough, well, then they can reject you for the coverage. Okay. So, yeah, remember, 99% of your life companies and only about 85-90% of the health companies pay into this. Okay. There are 4 basic classes of life insurance. All of the selections listed below are regulated as ordinary insurance, except group life. Remember, ordinary means individual. Okay, group is group. It's a different class. Okay. All right, different types of insurance. Let's start with term insurance. 3 types depending on what the face amount does. We have level, we have decreasing, we have increasing. All right, it doesn't matter what the face amount does. Your premium will be level during the term policy period. So if it's a 20-year decreasing term, as the face amount decreases over the 20-year period, your premium payments during that period are going to be the same level. Let's say $20 a month for 20 years, even though as you get older, you're buying less and less and less coverage. We typically use decreasing term to cover a financial obligation. The most common item that you'll get regarding this will be covering a mortgage. So if you bought a house, as you pay off the house, you owe less and less and less. And this is designed to just cover that outstanding balance. So if something happens, the house is paid off. Okay. Increasing term, as time goes on, you're buying more and more coverage. Now the premium is still level. That one's going to be expensive because you're buying more coverage when you're older and it costs more. Okay. And all of it's factored into the level premium. And it's not very common. Like, I don't see increasing term sold by itself. At least I haven't. I've seen it as a rider added to a life insurance policy, but I typically haven't seen it sold individually, independently by itself, just so you know. Not to say it doesn't exist. I just haven't seen it. Okay. Level term is the most common. All right. But again, it only pays if you die during the term. If you outlive the term, you get nothing. So I equate this to renting. You know, renting typically is inexpensive. You have a place to stay and you pay for the month. And at the end of the month, you don't get anything back. Okay. Same thing with term. You paid for some insurance in case something happens, but if you outlive the term, nothing's paid. Okay. So, and you don't get anything back. Now, on the bottom left-hand corner, we have convertible, we have renewable. Let's start with renewable. At the end of the term, some companies will let you renew for another term. So if it's a 10-year term and you outlive the 10 years, if it's renewable, you can renew for another 10 years. Okay. Now, you get to renew without a medical exam. The catch is when you renew, you're now 10 years older. It means you're 10 years closer to dying. So even though you're allowed to renew without a medical exam, your rates are going to go up because you're 10 years older. Okay, but you'll still have, level premium for the next 10 years, just at a higher premium. So a lot of companies also offer you the option to convert. So that's be convertible. Since term is temporary, if it's convertible during the term, you can convert your temporary program to one of the permanent policies from that same company that they offer, like whole life. Because if you don't like term because you think you're going to outlive it, all right, well then convert it during the term to a permanent policy so you maintain the same face amount, but now you have coverage for the rest of your life. Okay, so convert from term to perm, same face amount. So there's no premium. There's no medical exam, and the premium does go up though, because the permanent policies cost a little bit more than the temporary policies. In some cases, a lot more. Okay? A lot of your companies offer their term insurance policies as renewable and convertible, so it gives you a lot of flexibility. Okay? From the descriptions below, identify which one is a term policy, and the simplest thing to look at is there's no cash value. Okay, your premiums increase, right? Face amount stays the same, no cash value. That's term insurance. All right. So one of the permanent policies we're going to talk is whole life, and whole life gets a name from the fact that it covers you for the whole of life, which is age 100. Okay. For the test, it's typically age 100. In the real world, now it's like age 121. Okay. People are living longer, and we have a 2001 Commissioner Standard Ordinary Mortality Table, which reflects that. And so our mortality tables go to age 121 now. Okay. So with whole life, you have a level death benefit. You have level coverage till age 100, and your cash value grows within the face amount. So as you can see here, this line right here, this is the death benefit. Let's say it's 100,000. Now this shaded portion, this is your cash value growing within that $100,000 death benefit face amount. So the more cash value you buy, because this grows at a fixed rate, your net insurance that you're buying decreases. So the more cash value you have, the less insurance you're buying as time goes on. All right, but if you add the two parts together, it's going to equal whatever that death benefit face amount is. So let's say the face amount's 100,000. That means when you first buy this policy, there's no cash value, so you're literally buying $100,000 of pure insurance. As you pay premium, your cash value starts to grow. So now let's say you're at this point in time, we have about 30,000 in the cash value. That means realistically, you're only buying 70,000 in insurance. The 30 in the cash value plus the 70 insurance equals this $100,000 face amount, death benefit. And again, as your cash value continues to grow, you're buying less and less insurance until at age 100, your cash value will grow and equal the face amount. This is when we say the policy matures or endows. So at age 100, when your cash value grows and equals the face amount, the insurance drops. We just cut you a check for your cash value, which, by the way, is the same as the face amount. So if you died before age 100, your beneficiaries get the face amount death benefit. But if you live to age 100, you get a check for the face amount or the death benefit. So you're the recipient of your own policy. Okay. So that's how you want to know it. At the very bottom, you have continuous level premium, right? Usually till age 100. We do have limited pay policies where, let's say, you retire at age 65, then you pay slightly higher premium, but at age 65, you can stop paying premiums, but you still have coverage till age 100. So it's kind of like taking and buying a new car, and instead of a 5-year loan, you pay it off in 3 years. That's what a limited pay life policy is. So even though you're done paying, you still have the coverage. Okay. The policy owner makes the last premium payment on his $250,000 non-par whole life policy today. The owner is 70 years of age. When will the cash value reach the $250,000? That's when he's turning age 100. So this is one of those limited pay programs where he pays premium at age 70. He can stop. Now, even though he stops paying premium, it's a whole life policy, so it's still in effect and covers him for $250,000 until age 100. Okay, so remember, at age 100, your policy matures. So when does the cash value reach 250 for whole life? Age 100. Okay. So what we can actually do is let's cover the whole family on one policy. So let's get a whole life policy on the breadwinner. Instead of buying a separate policy for the spouse and maybe 2 or 3 policies, one for each of the kids, why don't we just get a whole life policy on the breadwinner, add the spouse as a term insurance rider, and add the children as a child rider. Now, this child rider covers one child or 999 kids. Oh, excuse me. I gotta walk around here. Oh, sorry. It covers all your children automatically, typically from birth. Depends on some companies. It could be like 5 days old or something. Okay, but all children of this marriage are automatically covered, or all children born into this marriage. Watch the terminology that you'll see on your policies there. Okay. So that means just because you have another kid doesn't mean the rate goes up. This child rider automatically covers all the children. But it covers them up to majority age, maybe 20, 21, or 25. Once your children turn 21 or 25, that child rider breaks off and converts to an individual policy that they can continue on their own. And there's no medical exam for that. All right. So a family policy is whole life on the breadwinner, term insurance on all the other family members, so the whole family's covered on one plan. Every once in a while, you'll see this called a family protection policy. All right. So what we're doing is we're taking the term policy, taking the whole life, and we're kind of blending them or combining them to hit specific needs. Another avenue is a family income policy. So whenever you see family income and family maintenance, which is the next one we'll talk about, it's only on the breadwinner. That means it's only on the person who makes the most money. That's how you want to know it for the test. So this is a combination policy of whole life and a decreasing term policy on that breadwinner. Okay. So we have permanent insurance, which is the whole life policy, and we have temporary insurance for a set period of time. Okay. So if you have minor children, this is perfect for you. So if the breadwinner passes away when the kids are still young, let's say it's a 20-year because you have a 1-year-old child, okay, and the breadwinner dies 10 years into this program. Surviving spouse gets this whole life in a lump sum to cover immediate needs, and then they're going to receive income for the remaining number of years of this decreasing term. So if you had a 1-year-old child, you got a 20-year decreasing term. Breadwinner dies on the 10th year. Surviving spouse gets the lump sum from the whole life and income for the remaining 10 years until the children are grown up and out of the house. How's that? Okay. So this term rider is designed to make income payments to the surviving spouse to cover living needs till the children are up and out of the house. So it's a combination policy. Now, family maintenance, we're going to take whole life, but this time it's going to be a level term rider instead of a decreasing term rider. And again, this is only on the breadwinner, whoever makes the most money. So now if the breadwinner died 10 years into this policy, the surviving spouse gets the lump sum from the whole life plus income for a specific number of years beginning at when the insured dies. So instead of paying to the end of the term, family maintenance pays for a specific number of years beginning at the death of the insured. Okay, so let's say 20 years. All right. So family income, it pays if you died halfway into this 20-year decreasing term period. The surviving spouse gets a lump sum from whole life and income for 10 years. But if he died with the family maintenance, the surviving spouse gets the lump sum and income payments for 20 years. It's a set number of years beginning at when the insured dies. Okay. All right. Now, on my website, I do have true and false questions. In California, we don't have true and false questions anymore on the test. They've pretty much taken them off. But in other states, you might still have them. So, okay. So a family life insurance policy that provides coverage for children may be converted to permanent insurance for the children, but evidence of insurability is required. And that's a false statement. Okay. Remember, when your children convert that child rider to an individual policy, they get to convert without a medical exam and continue the coverage. Okay. Survivorship life or second to die policies are going to be all the above. Okay. It's a second to die, so we're covering husband and wife typically on one plan. Since it's called a second to die, we don't pay anything when the first spouse dies. We pay the full face amount after husband and wife both die. That's when we pay to the named beneficiary. Okay. And so, yeah, the face amounts are typically $1 million or more to cover estate taxes. And that's that lump sum of money needed right at the time of death to cover that. Federal estate taxes are due within 9 months of death. So if you don't have something in place to cover that, then you're forced to sell more and more of your assets quickly. And if you're going to sell your assets quickly, I don't think you'll get a good price for it. Okay. And it is actually quite cheaper than buying two separate policies for $1 million each. All right. So frequently, juvenile life policies contain a payor rider. That means in the event that payer premiums, which is the policy owner, right, dies or becomes disabled, and the juvenile has yet to reach a certain age, the insurance company will waive the premium on the child's policy until they reach a certain age, and then the child can then choose to continue that coverage. So this particular rider preserves the policy on children in the event the parent policy owner dies or becomes disabled before they hit a majority age. Okay. Um, yeah, in a sense, the insurance company pays a premium on the child's policy until they hit age 21 or 25, and then they give the policy to the child who has the option to continue it or not. Okay, that's how that works. Universal life. Well, what we're going to do is we're going to take a whole life, and at the bottom here, you'll notice instead of a fixed level premium, we're going to have flexible premium. So whenever you see the word universal on this test, associate it with flexible premium. Another change from the whole life structure, which everything was fixed, set in stone, in a universal life policy, the cash value is going to grow at a current rate of interest with a guaranteed minimum. And so the whole life policy, everything's set in stone. You have a fixed interest rate in the cash value. Universal life, we're going to give you the current rate with a guaranteed minimum. So if interest rates go up, you get the upswing of interest rates credited into the cash value of your policy. But if interest rates ever drop too low, there's a guaranteed minimum to keep you from losing your cash value because of interest rates. Okay, so that's all it is. Think of a flexible premium whole life policy, right? Because in a nutshell, that's kind of what it is. Okay. Index universal life still says universal life, so it still has a flexible premium concept. Okay, but now instead of using interest rates, we're going to tie your cash value into a stock market index. So it's an indexed crediting strategy, like the S&P 500 or Standard & Poor 500. Okay, so it's basically tracking a stock market index, 500 large capitalized company stocks, and we credit that to your cash value up to a ceiling and typically a floor, which is a minimum. So you get the upswing through a stock market index, the upswing of the growth of the stock market through an index with a guaranteed minimum called the contract rate. So a lot of people like this. One of the most sold products as far as permanent policies in the past couple of years. Excuse me. This cough does not want to leave me. I apologize. Okay. So again, it's more of a flexible premium whole life policy, which gives you the upswing of cash value using an index. Sorry. All right. So when premiums are paid into a universal life insurance policy, the insurers must make certain adjustments to the cash value. The company will add the current premium paid and take out the expenses like mortality, which is cost of insurance, and company expenses, and then credit current interest. So let me rephrase this. Life insurance is a cup. And with a universal life policy, when you pay premium into this policy, your premium goes into the cup, into the cash value. When it goes into the cash value, the insurance company is going to take out the cost of expenses to keep the company around and to deduct also the cost of insurance, which we call the mortality cost. Then they're going to determine what their return is, and they're going to credit you the current rate of interest. So when your premium goes into the cash value, it's already earning that contract rate, let's say 3%. And if the company's earning 6%, then your money goes in the cash value. Excuse me. It earns 3%. We take out the cost of insurance and expenses, and then we credit the 3%. So the 3% contract rate plus a 3% credit basically gives you the 6% current rate. So these are the adjustments that are made to the cash value of a universal life policy. The one that's not an adjustment is subtracting surrender charges. Okay, so this question may change, like which of the following is not an adjustment made to the cash value of a universal life policy? And that would be deducting surrender charges. The only time you're going to have surrender charges is basically if you give up the contract, right? During the early years. Surrender charges is kind of a penalty for leaving too soon. Okay, so variable universal life. Excuse me. So variable universal life or variable life. Whenever you see the word variable, think securities. Right? Remember, anytime you see the word universal, think flexible premium. Don't mix them up. Some people came to me, hey, my client wants a universal life policy. Don't I have to have a securities license to sell it? No. Universal just means flexible premium. Variable means you have to have a securities license. Okay. And so, since it's using securities, these contracts are regulated by the SEC because you're using investments in the cash value. Your clients actually choose the investments. They pick the stocks, bonds, mutual funds, and the cash value. So you have to have that securities license along with your life agent license in order to sell this particular program. So it's a blend of two worlds, the insurance world and the securities world. Now, the thing about this particular program is all the other programs up until now had a guaranteed minimum return. In case the interest rates dropped or your index crediting strategy didn't do well, at least there's a minimum. Variable, there's no minimum. Okay, so the performance of the cash value is totally dependent upon the investments you choose. So if your clients choose some really good investments, they could have substantial cash value to dip into later on in life. But if they choose some lousy investments, they could have little or no cash value because there is no guaranteed minimum. So if you can't handle risk, this is not the program to talk about. If your clients can handle risk, then this is something you can bring on the table if you have your securities registration. Okay. So think of whole life as a permanent policy for someone who's very conservative. Variable is a permanent policy for someone who's very aggressive in their investment strategies. And then the universal or index universal is kind of the midway point between those two. Right? So in determining a permanent policy, I mean, okay, if you can afford it, because they do cost more than term, how much risk can you handle? That'd be the next question to ask is how much risk tolerance do you have? Because if you can't handle a lot of risk, let's stick with the fixed products. If you can manage risk and you've already invested in the stock market currently, well, then we can look at some variable contracts. Okay. Variable life insurance policies and variable annuities are primarily governed by which agency? And it's securities, so it's the SEC, Securities and Exchange Commission. Okay. When an insured becomes totally and permanently disabled, her condition triggers a provision that keeps the policy in force even though the insured stops making premium payments. This is called waiver premium. Most of your exams, you have between 4 to 6 questions just on riders. Now, a rider has no independent existence. It actually has to be attached and made a part of something else. The most common rider and the most sold rider in the insurance industry is this one, the waiver premium. So if you suffered a disability where you're not working, you still have to pay the premium for the first 6 months that disability continues. After 6 months, if you're still disabled as the policy defines, the company will waive your premiums on the policy while that disability continues. Your policy stays in force, up and running, without paying premium payments because you're disabled and you have this particular rider added to your contract. Most companies will typically reimburse you the first 6 months premium too, by the way. Okay. All right, Beth wants to purchase more life insurance through her current policy. She calls you, the agent, and asks your opinion. You know, Beth has a guaranteed insurability rider on the policy, so she can buy more insurance only at certain ages, dates, or anniversaries. Don't pick D at any time. It's at certain ages, dates, or anniversaries. Now, you're allowed to buy more coverage without a medical exam for the insured. All right, so yeah, that's kind of a good one. So for younger people, it's great because you can only buy so much life insurance for a younger person, especially a child. So as they get older, their needs increase, and this allows them to buy more coverage regardless of their insurable condition. Okay. Oscar owns a whole life policy that he has been paying into for many years. He'd like to continue having life insurance and can afford to make the premium payments, but needs about 30% of the cash value for a couple of years. What would be the best course of action for Oscar to take? Since he can still afford to pay the premium, have him just take a loan. Whatever you want to do, well, one of the things you don't want to do is have him drop the policy to take the money out. So keep that in mind. And again, as you can see, answers C and D find another source of funds, find another source of funds. Okay. I mean, they're very similar. So, I mean, I probably wouldn't go with that. It used to say choose another answer on these two. So the verbiage of the test has changed a little bit. But yeah, just take a loan. For the permanent policies that build cash value, the cash value grows on a tax deferred basis. That means interest compounds on interest. You don't have to pay taxes on the growth. When you need the money and you want to access the cash value, you can access the cash value taking tax free loans and withdrawals that you don't have to pay back, no credit check. Don't even have to give the insurance company a reason why you need the money. That's not bad. So it's a savings program within the life insurance policy, in a sense. Okay. Don't focus on selling it as a savings program. Make sure you mention this is life insurance, and this happens to be the living benefit of life insurance. Okay. So, but yeah, you can do that. David has been named as an irrevocable beneficiary in a life insurance policy. David, therefore, has a vested interest in the proceeds of the policy. So most people, when they name beneficiaries on their life insurance, they name a revocable beneficiary. Revocable means you can change it any time. Irrevocable means a beneficiary is set in stone. The only way to change an irrevocable beneficiary is if you have the irrevocable beneficiary's written permission to change it. That means with an irrevocable beneficiary, you can't change a beneficiary. You can't drop the policy because if you drop it and die, they have a legal claim against your estate. You can't even take a loan on a policy with an irrevocable beneficiary unless you have the irrevocable beneficiary's permission to take the loan. Because if you take a loan out and you don't pay it back and then you pass away, that's going to reduce what that beneficiary is legally entitled to. You see, so you need their permission for that. Okay. So where it comes into play is estate planning, maybe a court order like a divorce decree. Okay. So if no other selection is made, which of the following settlement options becomes the default or automatic mode of settlement for the death benefits of a life insurance policy? It's lump sum. Another way of saying this is which of the following is not a life insurance settlement option? And that's lump sum. Lump sum is not an option. It's automatic. Unless you chose to have the proceeds paid in payments to a beneficiary, it's going to automatically be paid in a lump sum. Okay. Non-forfeiture options. You'll typically get 2 questions just on this topic. So what it is you have a life insurance policy. It's a permanent policy. You built up some cash value. And at some point in time, you're just realizing, I just don't want to pay for this thing anymore. Okay. So these are some options. If you have cash value, they're called non-forfeiture because if you give up the policy, you do not forfeit the cash value. That is your money. But you can do something with it. The first thing you can do is the bottom left-hand corner here is give up the policy, take the money, and run. That's called the cash surrender value. Again, you drop the insurance, take the cash value, and run. Go shopping, do whatever you want. But no more insurance. All right, you just gave it up, took the cash value, and run. So instead of doing that on the top right-hand corner, let's say you still need to maintain that same face amount. You just don't want to pay premiums anymore. So we're going to give up this original policy, take the cash value, and use it to buy a term policy with that same face amount death benefit. Okay. So you get to maintain the same face amount for a period of time without paying premiums. That's called extended term. However, term does end. So this is going to end, and there's no cash value with that. So if you don't like that, because you're probably going to outlive it, right? Or there's no cash value, then don't use that option. Try the bottom right-hand corner. Let's drop this original policy, take the cash value, and just buy a smaller face amount policy, a permanent policy that's going to cover us for the rest of our lives. So we have this, let's say this $100,000 original policy. We can drop it, take the money and run. We can drop it, take the cash value and apply it to a term policy with the same $100,000 face amount, okay, that we're probably going to outlive. Or we can take it and drop it, use the cash value to buy a smaller policy, let's say $60,000, that'll cover us the rest of our life. Okay, you got to know the difference. It's called non-forfeiture option because if you drop your policy, you do not forfeit your cash value. Do something else with it. Okay. All of the following are true regarding a policy owner that ceases making premium payments on a 10-pay life policy and selects the extended term insurance option, except, see, there's these negatives here. The extended term policy will reflect the same cash value. No, because when you go from a permanent policy to extended term, there's no more cash value. Okay, so that would be the wrong statement, which is what they're looking for. That means answer A, B, and C are actually correct statements about this particular option. Okay, so it's another way of looking at it, another way of studying. Right. An annuity. A lot of people think annuities are very difficult, some financial product that, is just too difficult to understand. Keep it simple. It's just a savings account with an insurance company instead of a bank. Okay. So on the left-hand side is the accumulation period where you're saving money on a tax-deferred basis until you build up a nice lump sum, and then like retirement, then you start taking payments from this lump sum to supplement your retirement. And when you're taking money out, that's called the annuity period. So you see how you're just saving money to a later date, and then you're living off of that money you were saving at retirement. Okay. Keep it that simple. While you're saving money, that's the accumulation period. When you're taking money out, that's the annuity period. Once you annuitize, that means you stop paying in, you start taking money out. There's no paying back in. Once you start taking money out, you don't put it back in. Okay, you're just taking payments. Now the taxation is based on what's called an exclusion ratio, and so all the money that you pay into the annuity is after-tax money. It's already been taxed. So when the money grows and you start taking money out, all the money you paid in comes back tax-free because you've already paid taxes before you put the money in. But then the gains are going to be taxed, okay, based on the exclusion ratio. So at the bottom, the exclusion ratio, if you look at that equation, it's the amount of money invested divided by the expected return, okay? And so I'll show you how that's going to show up in a test question. But think of just annuities, just a savings account with an insurance company instead of a bank. Okay, it's not life insurance, but it is a contract with a life insurance company. So when the public purchases annuities, they're attempting to redress the risk of living too long. See, life insurance protects against dying too soon. Annuities protect against living too long. It's designed to supplement retirement. Okay. It's kind of funny that statistically, people that buy annuities live longer than people who don't. Right? Don't use it as a marketing ploy. Hey, if you buy an annuity, you're going to live longer. That's not what that's about. Right? It's you got to look at the personality of the person that's planning for the retirement. See, if you have something to look forward to at retirement, you're most likely going to get there. But if you have nothing to look forward to at retirement except being a greeter or wearing a blue apron somewhere, there's not a lot of incentive to live an extended life. Okay, so mental frustrations develop into physical manifestations, and things happen. Okay, so yeah, you buy annuities to provide money that'll last you for a set number of years or for the rest of your life. Okay, so we have some annuities that you cannot outlive the money. Okay. So Patrick has been diligent in investing money for his retirement. He's managed to put $100,000 of after-tax money into a tax-deferred annuity. Now he's ready to take it out. And the insurance company that issued the annuity says his guaranteed payment is $8,000 a year for the remainder of his life. This means he can expect a total amount of $200,000 back over his lifetime. How much of each year's annuity payment is taxable? So now we go back to that exclusion ratio, okay? And at the bottom here, as you can see, the amount of invested, right, divided by the expected return. And so he put 100,000 in, okay? That's what 100,000 is what he paid in. He's expecting 200,000 back out. So 100 divided by 200, all right, we can simplify that. That means 1/2 of every payment is getting his premium back. That means the other half, all right, so if he's getting $8,000 a year, half of that $8,000 is getting his money back. That means the other $4,000 is going to be taxable. Okay, Okay, so it's called an exclusion ratio because you're determining how much of each payment is excluded from tax, which means the rest is taxable. Okay. Okay. So Jennifer's reached a time in her life where she wishes to begin receiving payments from her tax-deferred annuity. Her agent has suggested she take the money out by means of a life income with 10 years certain option. So when she does, the insurer will make payments. Well, we're going to pay for 10 years or until she dies, whichever occurs last. That's what that's about. Okay. So yeah, could be life income with 20 years certain. So it means we'll pay you for 20 years or until you die, whichever occurs last. That's how this is set up. Okay. So there's different ways of taking money out of the annuity. A lot of times your annuity settlement options are the same as life insurance settlement options. Okay. So life insurance creates an immediate estate. There's a lump sum available right at the time that it's needed at the time of death. Annuities are designed to liquidate an estate through periodic payments. And so you can look at it this way. Let's say, Uncle Harry has a life insurance policy. You're named as beneficiary. When Uncle Harry dies, he's going to leave you $1 million in a lump sum. So how are you going to take payments from that lump sum? Or are you going to just take the full lump sum and be like lottery winners who have to go back to work because they spent all the money? Okay. And so why not take that $1 million from the life insurance, single premium purchase an annuity to where the insurance company holds the money and we just make you a steady income payment for the rest of your life. Okay. That's how life insurance can work. Now, let's say we don't have an Uncle Harry to give us $1 million when they pass away. So in buying an annuity, you're saving the money yourself to generate a lump sum of, let's say, $1 million to where you can live off that money yourself. Okay, but that's basically it. So the life insurance settlement options and annuity settlement options are very similar. Okay, we have a lump sum of money. How do we want to make payments? Either we make payments to a beneficiary from life insurance, or we're making payments to the annuitant if it's an annuity. Okay, but same concept. Okay, all right. So annuities. So if you single premium buy this, you can immediately start taking money out, typically within 1 year. But you can single premium buy the annuity and defer it, like let's say postpone when you want to take payments out till retirement. Okay. So single premium, you can take money immediately or postpone it to retirement. Immediate means within 1 year. Deferred means after 1 year. Okay. Now, if you don't have a lump sum sitting around, then you can do a flexible premium payment program where you're systematically making payments. But if you're doing flexible payment, you cannot immediately start taking money out. So you've got to build up an estate before you can turn around and liquidate it. So flexible premium has to be deferred as far as when you're going to annuitize. All right. So basically, there's no such thing as a flexible payment immediate annuity. Okay, because again, you got to build up an estate before you can turn around and start liquidating it. Now, with an insurance company, we have a couple different accounts. We have the general account, we have the separate account. Now, whenever you hear the general account, these are your fixed products. So your money goes into the insurance company, into the general account, and into the investments that the insurance company has chosen. See, remember, whole life, I'm going to give you a fixed rate of return. Universal life, I'll give you current interest rate with a guaranteed minimum. Fixed annuities are kind of like whole life. It's basically a fixed rate of return. So if I, the insurance company, are on the hook to give you a fixed or guaranteed rate of return, I, the insurance company, manage your cash value. You don't have a say-so in where your money is invested in your cash value of these policies. So some companies have set up a separate account, all right, to where your money goes into the insurance company, into the separate account, and into the stock market, which is, could be stocks, bonds, mutual funds. So your clients choose the investments. If your clients choose the investments, they take the risk. Okay, so a separate account, there's no guarantee of cash value. All right, keep that in mind. All right. So whenever you see separate account, think of securities. Okay, whenever you see general account, think of fixed products. So an example, we got some questions here. An annuity, which may be used to help fund retirement in a few years, maintains a separate account. The owner purchases accumulation units, and therefore this would be what gave it away is really the separate account. Okay, so whenever you see separate account, think variable products. Now, another way of for annuities is during the growth phase, you have its accumulation period. But with a variable annuity, you're buying accumulation units. Okay, when you annuitize, right, in a variable annuity, then these accumulation units are converted to annuity units. Okay, so whenever you see separate account or units, think it's a variable contract. Okay, just so you know. All right, so we're going to jump over to the health insurance side. Which of the following is true about a service provider as it relates to health insurance? Anytime you see service provider or service basis, that means when you go in and get the care that you need, we're going to pay the doctors and hospitals directly. That's called a service plan. So we make payments directly to the doctors and hospitals for your care. Okay. Blue Cross, Blue Shield are both service plans. HMOs, PPOs are typically service plans also. Okay. From the items listed below, choose the characteristic not found in the HMO's gatekeeper system. So which is not part of an HMO, and this is a double negative. There is no provision for services to be covered without the okay of the gatekeeper. So you have a negative in the question, which is not true about an HMO, and C is that there is not a provision regarding a gatekeeper, and there is. So this is a really tricky double negative question where you have a negative in the question, negative in the answer. So it's not that you get the double negatives just in the question, like which of the following is not correct except. Okay, so be wary of these. All right. Whenever you see gatekeeper, capitation, primary care physician, associate with HMOs. All right, so those are some key words. A PPO is an offshoot of the HMO system. Which of the following statements is false about a PPO? And actually, they're all false. So under preferred provider organization, you're going to get a list of doctors and hospitals in your local area. So if you need to see a specialist, you look on the list, you find one near home or work, you call them up, and you go directly to them. Now, if you go to the doctor on the list, this is called in-network, and it's cheaper if you stick to the ones on the list. Right? But let's say you have a specialist that you've gone to in the past, and you notice they're not on this list. Well, you can still go to them. That's called out-of-network doctor, and we will still help pay for your medical care. However, it will cost you less if you stick to the ones on the list. Okay. But whether they're on the list or off the list, you can still go. We still help pay. Like I said, it's just cheaper if you stick to the ones on the list. Okay. And so a PPO will pay no benefit unless you choose a PPO approved doctor. No, you can choose one who's not on the list and we still help pay. Okay. If a member sees a doctor that is not PPO approved, there is no reduction in the payment of services. Well, yeah, there is. Remember, you have to pay more if you go to someone who's not on the list. PPOs compensate doctors through a system called capitation. No, anytime you see capitation, that's only HMOs. Okay, capitation charge, that's part of an HMO program. Select the statement that best describes a multiple employer trust. Now, whenever you see trust, think of a separate legal entity. And where this comes into play is we have a group of small businesses that join together to promote their group and in the process pick up insurance rates at a better price. Okay. You can't form a group just to get cheaper rates for insurance. Okay. So if it's a group of small businesses like the Chamber of Commerce, they form a group called the Chamber of Commerce, and they join this group to promote their business with other businesses. All right. That's the function or the purpose of that group. And in the process, then they can purchase a group insurance program for the group members. Okay, strengthen numbers, you get a cheaper rate. Okay, and so this is the best answer here. All right, but look for a separate legal entity whenever you see trust. It's very common. Okay. Which of the following is true in regard to health insurance issued on a group basis? And remember, non-contributory, all the eligible employees have to be part of the plan, have to be allowed to be part of the plan. Whenever you see non-contributory, think 100%. Whenever you see contributory, associated with 75%, where you have to have 75% of the employees on the plan. Okay. The grace period. There's a difference between a free look period. When someone buys a policy and you deliver it, they have a period of time to read it, review it. If they're not happy, they can return it during this free look period, and they get a full premium refund. Now, the free look period is usually 10 to 30 days. Okay, usually 10 days for most people, but anyone who's 60 years of age or older, they get a 30-day free look period. Okay, so it gives them more time to read it, take it to their family and friends, including their attorney, to see if it was a good purchase for them. So then they buy the policy, and then after a couple months, they're behind on the premium payment. Well, now if they don't pay the premium by the due date, now they have a grace period. Okay. In life insurance in California, the grace period is 60 days. In other states, it's still maybe 30 to 31 days. Okay. So after the premium due date, you have like another month to still pay the premium, keep the policy in force without going through a medical exam and without a penalty fee. Okay. Now, if a client suffers a loss during the grace period, they're actually covered. Okay. Now, that's for life insurance. In California, it's 60 days. Other states, it's 30 to 31 days. But in the health insurance world, which is disability insurance, your grace period is contingent upon how often you pay the premium. So if you have a weekly policy, you have a 7-day grace period. If you pay premiums monthly, then you have a 10-day grace period. If you pay premiums quarterly, semi-annually, or annually, then you have a 31-day grace period, which, by the way, your test sometimes says 1 month. 30 or 31 days is the same as 1 month. Okay. Now, if you suffer loss during the grace period, you're covered. If you don't pay the premium by the end of the grace period, your policy will lapse for non-payment of premium. But the next topic over here, you can actually reinstate that policy that you let lapse. Now, there's 4 things you need to do. You're going to have to apply for reinstatement. You have to pay the past due premium that you should have paid, plus interest on the past due premium, because if you paid on time, the insurance company would have invested and made money, right? So, and also have to go through evidence of insurability, which is going through another medical exam. You see, because if your condition has changed, we may not want you back. But if you do qualify for reinstatement, you can reinstate a policy that you let lapse for up to 3 years. Now, always remember that you can only reinstate because you let the policy lapse for non-payment of premium. See, if you didn't want the policy anymore and you just canceled it, then you can't reinstate because you canceled. This is reinstating because of non-payment of premium. Okay. So if the premium on an individual health insurance policy is paid annually, semi-annually, or quarterly, the minimum grace period would be 30, 31 days, which is basically 1 month. Okay. A disability policy is issued and premiums are paid on an annual basis on the 1st of January. At the first anniversary, the insured decides they do not want to renew the policy and they do not pay the premium. On the 8th day after the premium due date, they submit a claim. How will the company respond? They're going to pay it because that loss occurred during the grace period. Remember, if they paid annual, they have a 31-day grace period. The insurer can change the premium, assuming it is changed for all insureds in a class. However, the company cannot refuse to renew the policy or cancel it. This is an example of a guaranteed renewable policy. And so what it is, you're guaranteed to renew, you just have to pay the premium. And so upon renewal, we cannot change the provisions or features or benefits of the policy. You just got to pay the premium. Now, the catch with a guaranteed renewable is you get to renew without a medical exam. But when you renew, you're older. So when you renew, your premiums are going to go up. Okay. And so that's why we can change it for a class of insureds. The insurer can change the premium, assuming it's changed for all insureds in a class. Okay, so that means age bands. So this one, as long as you pay the increase in premium on every renewal, you don't have to have a medical exam. You can continue coverage. Most policies are sold as guaranteed renewable. Non-cancelable, think of whole life insurance. Okay, whole life, that premium is level and fixed and straight and doesn't change until age 100. And so the insurance company cannot change the premium, cannot change the benefits, terms, or conditions. This is non-cancelable. Okay, so most policies are sold as guaranteed renewable. Number one, because it's got the word guarantee, and number two, is cheaper initially. But another question says, with all things being equal, what should you, the agent, recommend? You should recommend non-cancelable. It's going to be a little more expensive initially, but your premiums will never, ever change. Now, as a senior citizen on fixed income, I don't think you want guaranteed renewable because the rates could increase as you get older and you could price yourself out of the market. Okay. So that's kind of the logistics of that. Some other things to know: coordination of benefits or COB provision deals with dependent coverage. We have two, a husband and wife. They both work for different companies, and they each name each other as a dependent on a group insurance program. Okay. So if the husband's injured, his company's policy will be primary, covering his medical bills. But if it doesn't cover everything, then the spouse's coverage could fill in the gaps. Okay. Likewise, if the spouse were to be injured, well, then the spouse's company's insurance will be primary for them. And then in this case, the husband's will be secondary. Okay. That's what coordination of benefits is all about. It's dependent coverage for typically spouses. Right. So don't pick the one on the test, which of the following is a correct statement about the coordination of benefits provision. Don't pick the answer that says there's someone who has two jobs and health insurance with both jobs. That's not the answer you're looking for. Look for the dependent coverage. All right. COBRA. View this as continuation of group health coverage. So you left the company for whatever reason. As long as you pay the premium, you can actually stay on that group insurance program for a set period of time until you get hired by another company and get on the new group program. So I view it as continuation of group health insurance. Right? And so when you get notified, you have 60 days to sign up and start paying the premium to stay on this program without a medical exam. You're going to pay what the employer was typically paying for you in premium, plus up to a 2% admin cost. That's what the 102% of cost is all about. You're allowed to stay on COBRA for 18 to 36 months, depending on why you left the company. So for termination, it's typically 18 months. If an employee dies, we have to offer it to their surviving family for 36 months. If your dependent child breaks away from dependent status, they can stay on this program for 36 months. If we dropped you to part-time status, so we don't have to offer you benefits, reduction in work hours, you'll see it sometimes called, then you get it for 18 months. Now, COBRA is federal, so it's for employers that have 20 or more employees, that they have to offer this continuation of the exact same group health benefits they had when they were employees. So if it's a smaller company, here in California, we have CalCOBRA. Same thing as federal COBRA, but it's for smaller employers, like 2 to 19 employees. Okay. Now, in all cases, if you leave a company, all right, you can be eligible for COBRA except for one situation. Termination for gross misconduct, you don't get COBRA. All right. So we caught you stealing from the office and we fired you. You're not entitled to COBRA. Okay. But in all other reasons, all other cases, you're typically eligible. Okay. All right. Arnold and Bertha are married and work for different firms. Arnold has group health insurance with his company that also insures Bertha. Likewise, Bertha has group health insurance also covering Arnold. Select the correct statement below about how benefits are affected by the coordination of benefits provision in both plans. Okay. So remember, Bertha files a claim. Her company's primary, right? And then Arnold's company will be secondary and fill in any gaps. Likewise, if Arnold's injured, his company will be primary and Bertha's will be secondary for his medical care. That's basically how that works. Okay. The definition: the inability to perform the duties of any occupation for which one is suited by reason of education, training, experience, or prior economic status. This definition of total disability is considered. Now, thing you got to look at, the inability to perform the duties of any occupation. So that tells me, number one, any occupation, it meets that definition. Okay. So now I look at my answers. This is what we call a double multiple. You have a 1, 2, 3, 4 up top, but don't pick from here. You actually have to pick from these answers here. Okay. So some people, they don't see the full question. They stop and they pick this one. Okay. And they wonder why they failed. I mean, I knew this stuff. Well, because actually in this case it worked out. But look at the whole question. Look at all the answers, right? But any occupation is very restrictive. Okay. And it's actually cheaper. So any occupation, that means if you suffer a disability, Let's say you're a $200,000 a year neurosurgeon, you get an accident, you have a pinched nerve, you get the shakes, you cannot perform neurosurgery anymore. If you had an any occupation definition, this actually may not pay you benefits. Right? So even though you can't do neurosurgery anymore because you have the shakes, right? Well, if you can go on tour and give lectures and teach other people, well, then you can still make some money with your background and experience. You see, that's why this is more restrictive. You're less likely to collect, but it's a cheaper program to encourage you to buy the policy. Okay. Now the other one is own occupation, and this is a very liberal definition, so it's less restrictive. So own occupation, if you're a $200,000 a year neurosurgeon, you get an accident, you have pinched nerve, you get the shakes, you can't perform neurosurgery anymore. Well, own occupation definition would actually pay benefits because you can't do your job that you were originally doing. Okay, and so the policy would pay. So it's less restrictive, but it's going to be more expensive for a policy. Okay, so most people buy any occupation because it's cheaper in price. But if you specialize, own occupation is the one you want to look for. Okay. Hospital confinement, sometimes called hospital indemnity, and once in a while called hospital income. Okay, this just pays a daily benefit because you're in a hospital, and it doesn't coordinate benefits with your other health insurance programs. Right. So even though you had an HMO with a $25 copay, you go into a hospital for 5 days. This can pay you like $300 to $600 a day. All right. So even though you have a copay, this can pay you, let's say, $500 a day times those 5 days. You get $2,500. Okay. You can use that for your prescription drugs, deductibles, copay, or go celebrate a nice dinner that you survived, whatever that incident was. Okay. It's part of a cafeteria plan. Another other types of cafeteria programs, which are limited policies, would be a cancer policy, intensive care policy, heart disease policy. It only pays benefits for certain types of disease, like cancer or heart disease. Okay, so it's very limited. So, which of the following is not a feature of a major medical insurance policy? Well, major medical has deductibles, co-insurance, out-of-pocket, stop-loss limits. It doesn't have capitation. Remember, whenever you see capitation, think HMO. All right. Some other terms to know. These are some federal acts. MRMIP, Major Risk Major Medical Insurance Program. So Major Risk Medical Insurance Program. That could actually be a test question. All right. And I didn't leave it to chance. It's actually this one. Major Risk Medical Insurance Program. So it could be a test question. What does MRMIP stand for? Okay. And now you know, Major Risk Medical Insurance Program. It is funded by the state of California. And so it's a state program to cover people that have pre-existing conditions. And to help afford this program to get it on the books, a lot of it comes from the tobacco tax. Okay. All right. So that's MRMIP. PCIP, Pre-Existing Condition Insurance Program, is the same thing as MRMIP, but it's the federal version. So it's basically people that have pre-existing conditions, right? We're letting them go ahead and get a program to cover it. There may be some limitations on how much is paid, but it does exist for them. Medical loss ratios, or MLR. Typically, we, the insurance company, for every dollar in premium we take in, we have to pay a certain percentage, like 85%, back to our policyholders as claims. I mean, they take in consideration the admin, but if we do not give 80% back to our policyholders in claims, then according to the government, we're gouging the consumer. And so we're going to return that premium back to the client, and it's going to be called a rebate. Okay, so medical loss ratios basically say if an insurance company, for every dollar in premium they take in, they have to give a certain percentage back in claims. If they overcharge the consumer, they have to give that premium money back to the consumer, and they're going to call it a rebate. Okay, PPACA, I just use ACA, Affordable Care Act. Well, number one, this allows children to remain as dependents on group insurance programs until age 26. All right. The PPACA has different medal plans. So think of the Olympics, bronze, silver, gold, and we're going to throw one more, platinum. Okay. So there's different metal plans. So depending on your income would determine how much of the government subsidy that you're going to get to help cover or offset the cost of the premium. Okay. Traditionally, we've seen the test use gold. So look for gold is 80%. Okay. So if you get that one, that's the most common one. Healthy Families is a health insurance program providing medical, dental, and vision for children is what you want to look for. ADA, that's Americans with Disabilities Act. Okay? So it basically helps define what is a disability, what's not a disability. Okay? So being blind, being deaf, can't walk, those are disabilities. Now, ADLs are activities of daily living, and these are items that could qualify you for long-term care benefits. So if you need help eating, dressing, bathing, walking, going to and from the toilet, that's a long-term care need. It's not a disability per se. So if you have severe arthritis where you can't button your shirt, that's a long-term care need. It's not a disability. Okay? So you got to know the difference. The test may ask you which of the following is or is not an example of a disability according to the ADA, or it may say which of the following is or is not an example of an activity of daily living under a long-term care policy. Okay, and so that would be that. So know the difference. Alzheimer's is a long-term care need. Alzheimer's is not a disability. Asthma, right, and symptoms of obesity are actually disabilities, but they're not long-term care needs. All right, so yeah, make sure you focus and study on that. You do get a few questions on that. Medical is just anyone who can afford a healthcare program. Medicare is medical care, typically for seniors. But if you've been on Social Security total disability for 24 months, we bump you on a Medicare program regardless of your age. Okay. And then Medi-Cal or Medicaid is a socialist type health care for people who cannot afford it. So look for medically needy, medically indigent. Okay. So yeah, when all else fails, you have no other means of paying for your medical care, apply. And if you qualify for Medicaid or Medi-Cal, then it'll help pick up. Okay. But it's a last resort. So if you have any assets, including savings account, check account, you're going to use that first before this will kick in. All right. So again, MRMIP is funded by the state of California along with the tobacco tax, right? Or with tobacco tax. When do benefits begin? Well, since you have pre-existing conditions, when you apply, you get actually placed on a waiting list. Okay, so it's not immediate. Okay. Family Medical Leave Act provides for a minimum amount of unpaid leave. Well, you get 12 weeks of unpaid leave. Right? So if you work for a company and you have a family member that needs long-term care from you, or you need to miss work, then you can apply for this and get 12 weeks of unpaid leave to take care of that family member. This is another example where this comes into play and can be used is for like us guys, in case birth of a child, we can take paternity leave. We can take time off of work for child birth. We can take time off from work for adopting a child. Okay. We can take time off from work to cover our own medical bills because we ran out of sick pay or vacation time. Okay. So those are the four areas where you can actually get 12 weeks unpaid leave per year and still have your job preserved for you. It is not taking time off from work to go to another country to look for a job. That's not an approved amount. And remember, it's 12 weeks unpaid leave. And so you're studying 12 weeks unpaid, 12 weeks unpaid. Then you take the test and they give you this question. The Family Medical Leave Act provides for what minimum amount of paid leave? Well, if it's 12 weeks unpaid, that means it's zero paid. Okay, so watch out. Don't get these associations where when you see Family Medical Leave Act or FMLA, you're picking 12 weeks as an answer because they gave you this question, and if you pick 12 weeks, you'd have got it wrong. Okay, so read the questions carefully. The test is tricky. Right? It's not just a material; it's just making sure you read it right too. So, which of the following is not a physician? You see how three are similar and one's kind of by itself, and there's only one right answer. Right? Ologist, 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 but optometrist, that doesn't quite fit. You see? So some things just kind of stand out that way, and then go with that. All right. A measure for rating an individual's need for long term care benefits is called activities of daily living. Now, the magic number for this is 2. So, if someone has a long term care policy, if they cannot perform 2 activities of daily living, that would be a trigger for this policy to start paying benefits. Okay. Viatical or life settlements are accomplished through the use of absolute assignment. So, what it is you have a life insurance policy, which, by the way, is an asset. And in the time of need, you can sell that asset. And so you're on the last leg of your life where you got diagnosed, you have 2 years left to live, and you don't have a lot of money to cover your medical bills, right? Well, why don't you contact a viatical settlement policy or viatical settlement company, I should say, that may buy your life insurance policy on you. Like I said, life insurance is an asset, and in the time of need, sell the asset, and viatical or life settlement companies would actually buy that policy from you. So if they buy the policy from you, they're going to take over the ownership and they're going to own a policy on your life until you die. So let's say you have a $500,000 face amount life policy. You're going to sell it to a viatical settlement company. They pay you 70%. That means they're going to give you 70% of the face amount and paid out to you. So with a $500,000 face amount, they give you 70%. They give you $350,000. And that gives you money to take care of your medical. But you're going to transfer the ownership of the policy you have on yourself to them. So now they own a life insurance policy on your life for that $500,000. So when you die from the ailment that you have, they're the beneficiary. They get the $500,000 face amount. Out of that $500,000, $350,000 was their initial investment they got back. And so that difference is $150,000 minus the premiums they paid till you passed away. That's profit for them. So this is what this market is about. This is called the secondary market for life insurance, where we're buying policies from terminally ill patients. Okay. So now, if you're giving complete total control of the policy to someone else, that's called an absolute assignment. If you're using your policy as collateral to secure a loan, that would be C, a collateral assignment. Okay, just in case you get that as a test question. I've had a couple of people give me some feedback that they saw that. Okay, so yeah, you can use your policy as collateral to secure work being done. So that if you die before the person who you hired to remodel your kitchen gets paid, they can pay them from the life insurance. Okay, so yeah. Tax laws have established the modified endowment contract, or MECs. Select the correct response. Taxing the living benefit of a modified endowment contract is not like a non-modified endowment contract. Okay, this seems kind of a redundant question, but it's a little tricky as far as trying to understand what are they even asking. So life insurance is virtually tax-free. After-tax premium, tax-deferred growth in the cash value, tax-free loans and withdrawals, and an income tax-free death benefit to the named beneficiary. That's how normal life insurance, permanent life insurance, works. Well, if you overfund your life insurance policy, you put too much money in it, then you're going to turn your life insurance policy into a modified endowment contract. Okay, so now it's still after-tax premium being paid into this policy. You still have tax-deferred growth on the cash value, but since you overfunded your policy, your withdrawals will be taxable, and if you're under 59.5, you also have a 10% federal penalty. So by overfunding your life insurance policy, you're going to lose some of the tax advantages that it comes with, and you may have a tax penalty. Okay, and so this is basically just saying that. So Congress basically says you have to watch how much you pay into a life insurance policy during the first 7 policy years. In most cases, after 7 years, then you can dump in all you want into it. Okay, but some people just really want to exploit the savings aspect of getting tax-free money later on in life by putting a ton of money into it. And Congress sets a limit on how much you can pay into it based on the face amount. So, okay. If a policy contains benefits for community-based services or home care, it must also cover all of these. So if you bought a long-term care policy that covers like community-based or home care, it has to come with hospice. home health services, and respite care. Now, respite care, you need to know the definition. Respite care, let's say you're taking care of one of your parents at home 7 days a week, 24 hours a day. Would you like a break? How about if you send them to a nursing home for a week to 2 weeks so you can have a break? So, respite care basically is giving the daily caregiver a break. Okay, so you need to know that definition. Industrial life insurance contains a limit disallowing any one person from having more than 10,000. So another way of saying this is the aggregate face amount of an industrial life policy is 10,000. That means the maximum you can buy is 10,000. Most people only bought 1 to 2,000 because back during the Industrial Revolution, that's all it cost for burials, 1 to 2,000. Okay, but the maximum would be 10,000. Now today we have a variation of this called home service life. Now we've raised the face amounts from 10 to 15,000 because cost of dying has gone up with the cost of living. Right, to keep that in mind. Some other topics. When you drive by a bank, they have member FDIC, fast disappearance of invested cash, I think it is. No, when you drive by a bank, it says member FDIC. So if a bank goes bankrupt, your account is guaranteed with up to 250,000 per account. Okay, and so for insurance companies, if your insurance company goes bankrupt at the time that a loss occurs, we have a California Life and Health Insurance Guarantee Association. This is our version of the FDIC that the bank has. There is a major difference. A bank advertises, sometimes flashing neon lettering, right, that they're part of the FDIC, that your accounts are guaranteed 250,000 per account. But in the insurance world, we cannot use the existence of this guarantee association as an inducement or an enticement for the sale of a policy. So you can't say, hey, you should buy from our company because we're backed by the guarantee association. Every insurance company has to be a member, so your company's not special. And as you can see, this third bullet here, the maximum we pay is $250,000 per any one life. So if you had $1 million policy and the company goes bankrupt at the time you have a heart attack and you die, the beneficiaries don't get the $1 million. They get 250,000 max per any one person. So you're one person. So you're not fully guaranteed, right? But this is kind of our version of FDIC. HICAP, Health Insurance Counseling Advocacy Program. A lot of people got about 3 to 4 questions on this topic. It's a toll-free, make sure you understand it's free, 800 number to call for seniors if they have any questions regarding senior health coverages, like Medicare, Medicare supplements, senior HMOs, and long-term care. So we have highly trained volunteers answer seniors' questions regarding senior health coverages. They can actually provide some legal assistance with claims. That's the advocacy program. Okay, but it's a toll-free info line. Okay, for seniors to call. So this is in California. I'm not sure if they're in other states, but we basically have a HICAP office in every county of the state. And you can just call up, make an appointment, and they'll basically tell you what your benefits are and what you're eligible for as a senior. So it's a pretty good program, but it's toll-free info line for seniors. That's how you need to know it. ERISA, Employee Retirement Income Security Act, oversees your group qualified programs. So as an employer, if you're offering retirement programs for your employees, ERISA is going to regulate it because they have to look out for the employees and for the plan participants and also their beneficiaries, making sure the money is handled properly. Okay, making sure the plan is in writing so people even know that there's a plan. So it regulates a lot of the qualified programs, including KEOs. Now, KEO is more of an individual, self-employed retirement program, right? Sometimes called an HR 10. Okay. All right. A qualified person may hold both a life and disability and a property and casualty license. And if you have both the life and the property and casualty license, this is called a concurrent license. Okay. So, yeah. All right, so this is the end. If you haven't registered, consider it. If not, give me a call if you have any questions while we're studying. I'm going to open this up to questions, so let me unmute everybody here. Give me just a second. We started with 5. We have 3 left. Okay. That was a lot, huh? All right, some of you are self-muted, so I'm going to open up. Any questions? Any slides you want to go back to? Jenny, Salvation? Sheila?
No, it was a great course. I learned a lot.
Uh-huh.
I really felt like I wasn't retaining the information or the class that I had taken to get my hours, but yeah, this helped a lot.
Oh, good. Remember, I have some recorded ones on YouTube.
Oh yeah, my girlfriend gave me those actually. So yeah.
Oh, subscribe. I'm trying to bump up my subscription.
Okay,
so
I will.
I can monetize my policy. So yeah. So,
Okay, I will.
Okay, cool. Thank you. So any questions, just reach out. Okay. I'm not a 9 to 5 guy, so evenings, weekends, if you're studying, just reach out.
Okay, great. Thank you.
Awesome. Thank you. All right. Anything else? Salvation? God, I love that name. All right. How's the studying been going? Oh, she disappeared on me. Sally, you there? How's the studying?
Good.
Good. All right.
Getting worried.
Why are you worried? Trust yourself.
Can you hear me?
Yeah.
Oh, this is awesome. I'm over here trying to type. Well, I missed the beginning of the webinar. So I just heard that this is the same video that we have on the back office.
This is the one on the webinar that's recorded on YouTube. Yes.
Oh, awesome.
I mean, I changed the verbiage and what I present because, some people give me some feedback, and so I kind of adjust each one here and there.
Did you record this one?
This one I actually did record. I'm not saying I did record. So, yeah.
So I can
post this. Again? Yeah, I can post this. Not a problem.
Awesome.
I just don't want to because I'm coughing through half of this. That's what I was about.
Oh, it's okay. I don't care. Yeah. I just want to get some info. My test is Saturday, and I'm kind of like getting stressed.
Okay. Have you been going through my questions on my website?
Yeah, but for some reason, my question is, the question that you have on your website, is it going to be almost the same? Because I have so many materials right now. It's just all over the place. I'm trying to concentrate what I need to focus on.
Okay. So you're in Northern California, correct? Or where are you at?
I'm in California, Sacramento, yes.
Okay. So my questions are going to look, because you haven't taken the test yet, have you?
Saturday.
No, but you haven't taken it before. This is your first time.
My first time, yes.
Okay. My questions look very, very close to what you're actually going to see. So I would recommend you don't use any other company's material because I know my questions are enough to get you through the test because my students are passing.
Really?
Yeah.
Okay, let me ask you a question.
You just want to go through my questions over and over and over again to where as you read the question, you kind of know the answer. Okay. What was that? Go ahead.
How come you won't let me go to the next page?
What do you mean? On my website?
Like I'm always, you know how when you went through the first item, it kind of like highlighted into a different color. And then when you go to the next one, it just seems like it's recognizing that I read it. Are you understanding me?
No. on my sample test questions or on the webinar?
You know how,
what do you mean?
On the sample questions. You know how you go to the back office?
Okay.
And the first exam question, I went through it.
Okay.
And then I went to the next one, but even though I finished reading the second one, it doesn't seem like I went through it. Are you understanding me?
So you're not retaining it? Is that what you're saying, or there's a glitch on the website?
Maybe I'm trying to put too much in my brain at the same time.
Are you studying for 20 minutes and taking a 5-minute break?
I think I kind of like went over 20 minutes. Yeah.
Take the break. Take the break. Get up, walk around, take the break, because it allows your mind the opportunity to refocus and you absorb more material. So you got to break up the studying. Otherwise, you'll go through the motions you won't retain.
Yeah, I think that's what's happening to me. So most of the questions that you have on your back are not test questions, similar.
Yeah.
So I can just disregard all of this that I have on my desk.
Yeah. So anytime someone takes a test, I try and pick their brain to have them regurgitate what they just saw. And I ask them always, what do I need to change? What do I need to add for my future students? And so they give me feedback like that also. And so I keep adjusting my questions to get as close to the actual test questions you're going to see as I can.
Huh. Okay. So if from tonight, this is Tuesday, after Friday night, just concentrate on your material.
Yeah, just keep going through my questions over and over again. And I have the playbook there, right?
Yeah, I have that.
Okay. So honestly, if you wanted to make flashcards, that's what my playbook is. So if you see this, look for this in the answer. If you see this, look for that in the answer. So it's basically kind of a flashcard booklet is what it really is.
Yeah, I printed that booklet.
Okay. You got it.
Yeah. So, okay. So I'm just going to disregard all my notes and concentrate on your answers and questions and answers.
So go over and over and over them. So as you're reading the question and as you're reading it, you kind of know the answer because it was familiar to you because you've seen it before. Then you're ready to take the test. Right.
So you got these questions from the actual test?
I can't say that, but yeah, something like that. Yeah. Okay.
No, I want you to make me feel like relief for a minute, like.
Yeah. Well, yeah. So here's the thing. I've had some people. They just ran the clock on one computer on the required hours and just studied my material on another computer, and in 1 week they took and passed the test without even really reading the concepts that they should have done on the 52-hour required course. All they did was go through my questions over and over again, and they passed.
So you think from tonight until Friday night, because Saturday morning I got to read at 7 o'clock. You think I can do it? I mean,
yeah, as long as 8 o'clock Friday night you stop studying and you get a good night's rest.
Okay.
Because you got to be well rested going in. Okay.
Okay. So on this one, you're gonna post it for me, right?
Yeah, I'll post it on you. That's right. I'm actually still recording this thing, so yeah, I'll post it. Okay.
Oh, thank you so much, Lauren. Okay, so tonight I'm gonna go ahead and maybe go through the whole thing, and then go again tomorrow night, and tomorrow night, and tomorrow night.
Yeah, you can. Okay.
So I'm gonna disregard everything that's on my desk except my playbook and my questions.
That's it. See, I know my material is good, especially in California. I know I can't vouch for other companies because I've seen some other companies' material, and a lot of the companies they're general, they're national. Now California has a unique team of test writers that make it very tricky, and so that's why a lot of my questions they look a little different. But when you take the test, you'll recognize it.
So these terms to know that you just the last part of your webinar, is that something I need to concentrate on?
The which part again? Say that again.
The terms to know, like the MR, MIP, the PCI.
Yeah, it's in the playbook too, actually.
So I need to concentrate on those?
Yeah, you want to take a look at that.
I mean, do I need to memorize the whole, because it's abbreviated. It's abbreviated.
No, not memorize. Just understand. When you see MR, MIP, right, know what MR, MIP stands for, Major Risk Medical Insurance Program. Okay, it's okay.
So when I see MR, MIP, I think of tobaccos.
Yeah, because it's funded by the state tobacco tax. Yeah.
So that's good. Okay.
Yeah. You see what I mean?
Yeah.
Okay. And when you apply, you got a waiting period before benefits begin.
Which is 6 months?
No, there's no time period on that one.
Oh,
okay? Just know that MR, MIP, there's a waiting period. That's it. Okay.
Oh, that's it. Okay. Which one is the one with the 6 months?
Waiver premium.
Waiver premium. Okay. See, I'm getting confused already.
That's okay, but through repetition, you'll recognize it, and when you see it, you'll already know. Oh, that's 6 months. That's just a waiting period. That's Social Security is a 5-month waiting period. Through repetition, you'll pick it up.
Okay.
So that's why you want to keep going through my questions, and you'll see some questions that are the same. They're similar. Just like your test, you may get that exact same question 2 to 3 times. So don't think I answered it this way this time. Let me answer it this way this time. No, it's the same question. Answer it the same way that you were taught.
Yeah,
Okay.
I have a question on like I wrote it down. A question 24A and 24B.
Mm-hmm.
I kept reading over and over again, and you have two similar questions with two different answers.
It's because one of them. Look at the words. There's one or two words that are different in the questions.
Okay.
And I put them side by side so you can recognize it. So when I see this word, this is the answer. When I see that word, this is the answer.
Okay. So that's what like. Why did he? Then again, maybe I didn't concentrate on the question.
Take another look. There's always a method to the madness in the things that I do.
Okay.
Okay.
Thank you so much. Okay, so I'm gonna just clean my desk and concentrate on my playbook. And do I need to start writing more? Because I feel like I'm writing a lot.
No, I don't know. I just read it over and over again, because remember, I'm giving you the answer. When you see this question, this is the answer you want to look for. When you see this question, this is the answer you want to look for. And so just make that association. Now, the verbiage on your test may change a little bit, but that concept, that doesn't change. You see?
Okay.
And so, through repetition, you'll pick it up, whether you want to or not. You'd be surprised. And trust yourself.
I'm going to reach out to you maybe like Thursday night.
Not a problem. I do have a fire and casualty cram course Thursday night from 5 to about 7:30. So just to give you a heads up, I won't be picking up phone calls during that time. But
I think I registered on that one.
Yeah, postpone it. Get this one passed first.
Okay.
Okay. Yeah, because that's a different world, and it's gonna. Yeah,
we don't want to.
Yeah, you don't want. I don't want you to be confused on this. So yeah.
So don't even worry about. Just concentrate on my tests.
Concentrate on the life and health first.
I'm so worried.
Okay.
That costs $83 to register on that test.
Yeah, for the test. Yeah. So yeah, focus on this one first.
Okay.
Okay.
Thank you so much. And you're gonna put this on the website.
Yeah, it'll go up tomorrow morning.
Oh, okay. At the meantime, I'll go ahead and listen to the old one.
Yeah, because what happens is I got to stop the recording, and then it's got to translate into an MP4, and then I can post it.
Okay. Thank you so much.
You got it.
Have a nice evening.
You too. All right. Thanks. Take care.
Thank you. All right. Bye-bye.
Bye-bye, everybody. All right.
Bye. Thank you.